So the next topic is audit sampling. So I told that I'm not covering risk assessment chapter because that is again a lengthy chapter. That's again a very lengthy chapter. But mainly we are covering main topics. But risk assessment brief idea I'll give you maybe at the end. Getting it? Now let's focus on sampling. See, instead of risk assessment, what I'll tell is you can study 3 chapters easily. Sampling, analytical, strategy. All these 3 together, minimum 15 to 20 marks. Minimum. Only risk assessment, if you study, it will have maximum 8 marks. Is it better to study these 3 and secure 20 or 8 studying that? But if both take same time. Risk assessment, internal control, how much amount time it takes. These 3 chapters together takes the same time. Getting it? So be strategical in your preparation. So fine. So sampling, here nothing but we are going to discuss about SEA 530. We are actually discussing about SEA 530. So what is this audit sampling exactly? Now what is this audit sample exactly? Just 1 minute. Now let's look at how in reality practically the sample works. First, if you understand this, like how exactly the sampling works, you might have seen in the sampling there are various topics called stratification, value weighted selection. You have seen all that, yes or no? And haphazard sampling, random sampling, simple random. What exactly the difference between them? All that we will see this with this practical illustration. This is a sales report given by the MS Excel itself. In the MS Excel itself, the sales report is there. The Excel itself, its own sales report. Now you see here, this is the total which I have calculated. Getting it? Now I'll just, this is the product which the company is actually dealing. And these are the customers who actually purchased. And this is the total value for which customer has bought the goods. Getting it? So in this Excel sheet, we will apply the sampling technique. Getting it? Now I'll copy this entire data. This is the raw data. This is the raw data. I'll copy this entire data onto another one. Another sheet I'll copy. And you see, this is the data and which I'm copying to another sheet. I'll zoom it. And in the column, I'll just remove it. So this is the total sale value and the customer and product. Getting it? Now what is the population value? 1,54,491. Getting it? A dollar or rupiah vitrunga. Just understand the concept. So serial number. How many transactions we have? Not 78. 277 transactions we have. So how many we have here the transactions? 277. Getting it? So what is the total transaction value? 1,54,491. So this is the status. This is a population. Correct? Now here my objective is to select 20 samples. Have you heard of random number tables? All of you? Now, how do I apply random number tables? This is population, filtered population, correct? This is population. I hope here it is visible to everybody. Here also, right? Yes. Now, from this, I apply simple random sampling. I apply simple random sampling. Getting it? Now, I want to select invoices. Totally how many invoices I want? 20. What is the invoice number? 1 to 277. 1 to 277 totally. And how many samples I want? 20. So random between 1 to 277. Correct? So 81. That sample we are selecting. Totally how many we want? 20 samples we want. So yes. So these are the samples which I'm going to select for audit. These are the samples which I'm going to select for the audit. 141 voucher, 211 voucher, 136 voucher, 163 voucher. Likewise up to 37. Understood or not? Now, so this voucher value, how much I will apply? This voucher value, how much I will check? So 141 voucher value is how much? 42. Getting it? Likewise, I'll apply. So this is the total vouchers which I have selected. What is the total voucher value which I have selected for sample? 11,614. Have you understood? 211 voucher value 60 rupees they said. We'll see 211 voucher value 60 rupees or not. Yeah, exactly. Correct? Huh? And here 163 voucher value they have selected. We'll see 163 voucher value. How much it is? 68. Here also it is 68. Correctly arrived or not? Now you tell me, these vouchers I have selected. No, these are the vouchers which I have selected. Numbers. Did I apply any my personal bias? They were randomly selected by using random number tables. What is random number table? Did I use any table book? Earlier we have table book. Now we have Excel sheet. So is there any number that came out of my choice? This is simple random sampling. Able to understand all of you. Now you see. Now let us apply. So what is the total value? Now what is the percentage of the total value to the total value of the population divided by what is the population total? So approximately it is 8%. Correct? Approximately 7.518%. So this is the sample value which I have selected in simple random selection. Correct? Now I will apply haphazard sampling. I'll apply haphazard sampling. Haphazard sampling means I am selecting randomly, but I am not using random number tables. Now haphazard selection. Have you heard of haphazard selection? Now I want how many samples? 20. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. So some last one, okay, 20. This is haphazard selection. Haphazard means what? I don't follow any technique. In haphazard selection, the auditor will not follow any structure technique. On the other hand, he will avoid personal bias. Have you seen this sentence? Is there any personal bias I used here? But randomly I selected. What's the difference between simple random sampling and haphazard? Both are random. But in simple random sampling, numbers also I will not use. I will use random number tables or computer scientific I'll select. Haphazard I will manually select. Both are random. Which is more scientific? Simple random sampling. Have you heard? Saw no simple random sampling. Now we'll see what are the samples that we filtered. What are the samples that we filtered in haphazard? I will filter to next, So these are the haphazard selections, right? Which I did. This is the sample which I selected in haphazard sampling. Correct? What is the sample which I have selected? 10,265. Now I'll apply. What is this total to population? Now what is the population here? So this is the population. Yes or no? So this divided by population. Now it is approximately 6.65%. Correct? Now this is simple random sampling, haphazard sampling. Correct? Everyone? Now, if I go to the again population, I'll apply block sampling. Block sampling means what? Selecting items of contiguous, like continuous items. Getting it? First number. In simple random sampling, first number is what? 141. This is randomly selected, right? I will take 141 as starting point. I will select next 20 items continuously. I will select 141 as starting point. Next 20 items. 141, 142, 143, 144, 145, 146 up to 20 items. I will select all 20 items at a stretch. This is what? Block sampling. Or I may have multiple starting items. Let me select block of 5 samples. Suppose 141 is one block. 141, 142, 143, 144, 145. These invoices I will select. Then what is my next random number? 211. From there again 5 samples I'll select. What is my next number? 136. From there again 5 samples I'll select. What is the next invoice? 210. From there again 5 samples. Like that totally 20 I'll select. This is block sampling. Able to understand. Next, what is systematic sampling? Have you heard of systematic sampling? Interval sampling. Systematic interval. Now, what is the total sampling units in the population? 277. There are totally 277 sampling units were there. From these 277 sampling units, I have to select 20 samples. I have to select how many? 20 samples. 277 divided by 20 is equal to how much? 14. Approximately it will come to 14. So, first item I will select. From there again 14th item I will select. From there 28th item I will select. From there again 42nd item I will select. Next 15th, 6th item I will select. Simply 14th table. So I will select, I will apply that. Those invoice numbers are my sample. This is systematic sampling or interval sampling, where between two invoices the interval is 14. Now if I apply 14 interval and select no entire population, how many samples I will end up with? 20. Understood. So this is systematic sampling. Now the most another thing is stratified random sampling. What is the leftover method? Stratified random sampling. Now you see here, let me apply stratified. Stratified will be selected here, okay? Stratified random sampling. Now you see, if you observe the population, is filter value you've seen? Filter. The value inside the table is visible slightly here. Here it is visible. What is the first number? 12.5. What is the first number? What is the last number? What is the last number? 4,700 approximately. The last number is 4,700 approximately. Correct? Huh? Are these both values similar values or extreme values? Very good. Are they homogeneous or heterogeneous? Heterogeneous means completely different. Now you see, when I see the population, now tell me, now I applied simple random, right? Random number tables I used, right? Can I say in this 4,700 rupees value has been damn sure selected? Can I say that? May or may not. Who knows? It's 277th invoice value. That is some invoice value 4,700. Can I say in the simple random sampling for sure 4,700 is selected? Can I say in haphazard 4,700 is for sure selected? I don't know. I just selected randomly. It may come, may not come. Correct? Huh? It may come or it may not come. Now tell me, when I study this population, when I observe this population, when I interpret this population, I discovered that there is an item which is 12 rupee. There is a sale value which is 100 rupee. There is a sale value which is 300. There is sale value which is 1000, 1500, 2000, 3000, 4000, 4700. Now the company is selling goods at various levels. Correct? To various customers. Now tell me, generally in any company, for selling small quantity and for selling high quantity, the process is same or slightly different? Differs. Correct? Now tell me, if I do not pay attention, if I do not observe this point and simply select 20, I may be ignoring high value items. Or I may be selecting mostly low value items. Can I treat high value items, low value items equally? See, in simple random sampling, I applied random number formula and I selected 20 samples. Any number might come, correct? Which means all invoices were given equal chance or not. In haphazard also all invoices were having chance or not. Correct? But when I studied this population, I discovered high value items. According to me, anything more than 2,500 rupees is high value in this company. In this company, sales more than 2,500 rupees is high value for me. 1,000 to 2,500 is medium value. Less than 1,000, low value. Can I select sample randomly from low value and randomly from medium value and also high value. If I select sample from all the three, can I cover all the parts of the population? Is my sample more representative? In population there are extreme values, in my sample also extremes are there. My sample is more representative. Able to understand? Now let me apply that technique. So I will filter samples having greater than 2500. How many were there? Sorry. 2500. How many came? Only 6 items were there. Big items are only 6. Why should I apply sample? I will select all the 6. Can I? I will select. What happens? What's wrong in this? So I will select all these items. Yes or no? All high value items. Getting it? I will select. You might have seen this. In value weighted selection, auditors focus mainly goes towards high value items. Have you seen that? Getting it? Now, then I will select medium value. Greater than 1000 but less than 2500. Sir, no. Oh my God. Here approximately 37 invoices were there. Between 1000 to 2500 only 37 were there. More than 2500 6 only were there. Totally 43. Small value items are approximately 230. Small value items are approximately 234 items were there. But as a whole, how many samples I want to test? 20 only. Already how many selected? I will select from this another 8. Yes or no? 1, 2. Here I apply again haphazard technique. Yes or no? So how many it is coming like here? How many? 7 I selected. So another number I will select. Randomly. Randomly I selected. What is stratified sampling? Dividing the population into subgroups and selecting sample from each group. That's what I am doing. Yes or no? First I divided the population into 3 parts. Items value more than 25. Items between 1000 and 25. Items less than 1000. From each part I am selecting sample. Randomly. That is called stratification random. Stratified random. Correct? Now, next, what is left over? Small value items we should select, no? So, less than 1000. So, less than 1000, I will select randomly how many? Already 8 plus 6, 14 were selected. Just another 6 items I will select. Yes or no? Just another 6 items I will select. Vandarcha? Yes. So, these 3 I will hide. So, what I have selected ultimately is this. These are the samples which I have selected. Hey, what happened? Did I select it in wrong column? Oh, sorry. Now, totally how many I have selected? 20. Correct? Now, I will filter these 20 into another place. This is what? Stratified. Yes or no? This is what? Stratified. Now, I will see the total. Now, you see in this my stratified sampling, small value items are selected, medium value items are selected, large value items are selected. Yes or no? Now, you see the total. 34,000. Now, you see the formula with the population. With the population if I check, approximately how much value it gained? 23%. You see, here also I have selected 20 samples only. Haphazard I selected 20 only. Simple random I selected 20 only. But I am selecting with the same 20. I am verifying more value. In which method? Stratified sampling. And I can say confidently, if someone asks me, have you verified material items? I verified. Have you verified medium items? I verified. If I focus only on these two, management may do frauds in low value items. I verified them as well sampling. My sample is more representative. Through this methods, we understood now what is haphazard, what is simple random, what is stratified random, what is interval sampling, what is block sampling. Understood or not? This is called statistical approach. What is non-statistical approach? Non-statistical approach means where I don't use all this scientific methods, probability methods, random methods. I don't apply. My favorite number, let us assume 1. I will select all the vouchers which will have one number. Able to understand? This is personal bias. What is this called as? Personal bias. Bias cannot be avoided. But tell me, whatever method of sample I am using, tell me what is the purpose of sample? What is the purpose of sample? I'll give two options. In order to draw conclusion on the sample, or in order to draw conclusion on the population. Exactly. The objective of sampling is not to select the sample, not to form an opinion on the sample, but to form an opinion on the. Yes, very good. That's it. So now we apply the sampling technique in test of controls. We apply the sampling technique in test of details. Now in the sample selection, is there a risk again? Sampling risk, we call it as. What is it called as? Sampling risk. What is sampling risk? What kind of wrong conclusions that we may end up because of the sampling risk? How to use the sampling technique? How to project the mistakes? All that we have in our syllabus. Are you getting it? So with this we understood scientifically how we apply sampling. Now we just have to look at the book. Just a minute. Yes. So now let's look at how, what are the concepts that we need to discuss. So in the previous exam, they gave a question, something related to this introduction. At the last there is another para which you will find in main book. Getting it? So non-routine checking, routine checking, that is the wordings which they used. So they indirectly asked you about the sampling. What is audit sampling? First of all, we apply our audit procedure. We verify. What do we verify? In a sampling method, we verify entire population or sample. Sample means less than 100% data. That's it. Audit sampling refers to application of verification procedures to less than 100% items within a. So that is called auditor sampling, based on which auditor draws conclusion about the static. Getting it? All of you. Now, just a minute. Now, what is the objective of auditor? The objective of auditor in sampling is to provide a reasonable basis to draw conclusion about the population from which the sample is selected. See, in the population in our example, 277 bills were there totally. Each item is called as sampling unit. Whatever is selected is called as sample. Are you getting the point? Next. This standard applies when the auditor decided to use either statistical or non-statistical sampling. Getting it? And when designing a testing sample, when performing test of controls and test of details, and how to evaluate the results based on sample. The moment you decided to adopt sampling technique, this standard SA 530 applies. SA 530 heading is audit sampling. The chapter heading is also audit sampling. Now, what do you mean by population? Population is nothing but entire set of data from where sample is selected, based upon which auditor will draw conclusions on the population. First, a population must be appropriate. Getting it? Appropriate population it should be. Appropriate means what? Relevant. What is the, from wherever, see what samples you want to select. See what you want to verify. Purchases I want to verify. What is, in order to verify purchases, what is appropriate population? Purchase register, DRN register, purchase order register. These are the appropriate population. Yes or no? Not only that, before you select the sample, you must ensure that the population is complete. If the population is incomplete, your conclusion on that incomplete population from where you drawn the sample will also be wrong. If you want to audit purchases, make sure entire purchases were populated first. From that you have to select. Suppose tell me in our example, out of 277, if 30 bills I removed and then selected sample, the result, will it be reliable? Exactly. And population from where you're drawing sample should be reliable. It should be generated independently. It should be generated by right person. Getting it? What is sampling unit? It is nothing but individual item in each and every individual item in the population. Total of sampling units is equal to population. Are you getting it? Now audit procedures are applied on these units which are selected, and conclusions will be drawn on the populations by using a projection, by using a technique called projection. By using a technique called projection, which is also called as extrapolation. Able to understand? Whatever conclusions we are drawing on sample, that conclusion becomes on the population. You see example of rice cooking. This we say, this quotation also we say. Getting it? So whether the rice has been cooked properly or not, cooked up. We don't check the entire each and every grain. We only check sample. Correct? If the sample is too wet, we say that the rice was not yet cooked up properly. Yes or no? It's not boiled properly. Now, what is the approach to sampling? We have two approaches. One is non-statistical approach, another one statistical. What is statistical approach? Where selection will happen on a random basis, where we use probability theory to evaluate the sample results. What is probability theory to evaluate sample results? Suppose out of 20 samples I have selected, out of 277, if I discover one mistake, it's 5%. It's 5%. 1 by 20 means 5. I naturally feel that in 277 also 5% mistakes were there. This is called probability application. But it is not as straight or as simple as what I told. First, whenever you discover a mistake in sample, first you should assess the nature and characteristics of the mistake. Is it anomaly or is it non-anomaly? You need to first understand that and accordingly apply. Able to understand? Now, sample is chosen by applying some mathematical and statistical methods. I use random tables, no? Yes. What is non-statistical? Which do not have the above features. Ultimately, what is the objective of sample? Selecting representative sample. Tell me, when the sample is representing the population correctly, only then my decision on the sample I can apply on population. Correct? Only if I select the sample correctly, which will have all the characteristics of the population. Getting it? Then only my sample is representative. So whatever approach you follow, ultimately the sample selection objective should be representative sample. Correct? And so the sample characteristics must be close, similar to whole population. Although not exactly same, but similarity should be there. Able to understand? Now, sampling process is performed on test of controls to identify deviation from the control. Whereas in details to identify misstatement. The word deviation is used in the context of control. Misstatement is used in the context of details. Remember. Able to understand, all of you. Next. So balance we will we will discuss in the next session. The balance continuation and all we will discuss in the next session. Clear? Hardly another 30 to 40 minutes, we'll close up this chapter. I'll give you a clear-cut idea of how to understand this chapter, then you can go and understand later easily. So let's continue. So we are discussing the difference between statistical and non-statistical sampling. The difference is, in statistical sampling, we use the probability theories. We apply mathematical calculations. Especially the statistical sampling is useful where large number of transactions were there in a given volume of data. So in that time the statistical sampling is useful, and in statistical sampling we don't have any personal bias in selecting the sample, and the evaluation will be absolutely scientific based on the result of the sample. And in case of larger organization, statistical sampling is something which is always recommended. Whereas non-statistical sampling, the sample is selected based on personal bias. See, when I am selecting sample unbiased means what? I am not looking at the item in the population when I am selecting. That's called unbiased selection. Biased selection means what? Where I will be looking at the item in the population and selecting that specifically for some reason. Able to understand? So that is called personal bias. So the degree of objectivity cannot be assured. How far you are independent in selection, that cannot be assured in case of non-statistical sampling. Moreover, in non-statistical sampling, we usually check it, large items, especially which are recorded at close, year end. At the closing time, whatever major transactions were there, that is what we generally check in non-statistical. See, first of all, we don't apply any non-statistical technique. By default, we select samples on random, right? The moment you select it on random basis, it is statistical sampling, simple. Next. And here, the results cannot be measured because they are not scientific, and moreover, in case of non-statistical sampling, the sample selected is not representative. Now they have given one MCQ, sorry, one correct or incorrect question in one of the exam. Sample size is not a valid criteria. Sample size is not a valid criteria to distinguish between statistical sampling and non-statistical sampling. This is a statement. The answer is correct. Sample size is not the criteria to differentiate between. Do we see any criteria regarding sample size here? What is the difference between statistical and non-statistical? Is there any discussion on sample size? Whether I select 20 samples out of 277, 25 I select, 30 I select, is there any link with the approach that we follow? Forget about approach. Even within statistical, simple random, stratified random, even there also we are not following based on sample size. Suppose have we seen in simple random 20, in stratified random 15 enough, like that have we seen? Sample size is not at all a criteria to distinguish between methods of sampling, approaches to sampling. Getting it? Sample size is a level. See, you need how much level of assurance? I need more level of assurance. Naturally, I select more number of transactions. Are you getting the point? So sample size will be that much where sampling risk is low. Nothing but where audit risk is low. Whatever sample size you feel sufficient, that's it. In audit evidence, we see sufficient appropriate evidence. Nothing but sample size. That is mainly dictating, that is mainly, directed towards sample size. Able to understand? Next. Now, how sampling is different from traditional methods of checking, which is something you can read on your own and understand. Easily you can understand. Getting it? Now, factors to be considered, this I'll come back again. Now, let's look at various methods of sampling. Sample selection and methods of testing under sampling. First of all, you shall select items in such a way that each sampling unit has a chance of selection. So every sampling unit should be given a chance. Every unit in the population should get some chance that it will be selected. This can be achieved only in statistical sampling. The purpose of sampling is to provide a basis for the auditor to draw conclusion about population from where it is selected. And it is important that auditor selects representative sample so that bias is avoided. Now, selection methods. We have so many selection methods. Getting it? We have so many selection methods. Simple random sampling means what? Simple random sampling means it's a method where each unit, every item in the population has equal chance of selection. Yes or no? We have seen formula. 1 to 271, any 20 items we want. We selected in Excel. Any number can be picked, right? So item number 1, what chances it has? Item number 279, what chances it has? Both are same. Equal chance. Random number tables are simple and easy to use and also provide assurance that bias does not affect. Now we use Excel sheet random number table technique. So is there any bias? Is there any my personal judgment in that number selection? No. This method is considered appropriate where population has a reasonably similar units. Now in our example, there is 12 rupee item, there is 4,700 rupee item. Simple random sampling, though it is fine, but when the variation is too heavy, is it right method? When simple random sampling can be applied when suppose entire population, all the amounts are more or less similar. They were in a particular range bound, not extreme variation. Then I can apply simple random sampling happily. But when the population comes having extreme variations, it is always better to divide the population into subparts and select sample from each subpart. Correct? So what is stratified? It means dividing heterogeneous, diversified into homogeneous populations. Yes or no? Now in our example, 12 rupees to 4,700 is the total population. We divided that into three categories: high value, middle value, low value. Now within low value, all items are similar. Within medium value, all items are similar. High value, all items are similar. That's what. So splitting heterogeneous population into homogeneous population. Now how can we stratify? In our example, we stratified it based on monetary unit. It is called as monetary unit sampling. We stratified it based on monetary unit. So we call it as monetary unit sampling. Able to understand? Stratified sampling, another name is monetary. Suppose I am doing audit of expenditure. I am doing audit of expenses. Expenses are so many. I will now classify them as three types: factory related expenses, admin related expenses, and sales related expenses. Can I classify like these three? This is also stratification only. But is this monetary unit sampling? Now here I am dividing the population into multiple parts based on the nature of expenditure, not the amount involved. Correct? So the method dividing whole population to be tested into few separate groups is called as strata. Each stratum is treated as if it is a separate population. Items will be selected from each of the stratum. Number of groups into which you have to divide is your professional judgment. We divided it into three parts. I may divide them into 5 parts. I may divide them into 7 parts. That's your choice. It's a matter of professional judgment. Generally, for the top group, 100% items we will verify. Correct? Why? Big items are generally less in items. So even though if you verify 100%, it is okay. Whereas from the lowest group, we verify 2%. Example. In our example also, 234 items were there. 6 items only we verified. Hardly 3% sample we verified from the lowest group. Yes or no? Able to understand? That's about stratified sampling. Now immediately we need to see the techniques of stratification and value weighted selection. So what is stratification? Stratification means what? Dividing population into discrete, means independent subpopulation which have identifying characteristics. We divided the population into 3 parts. Value more than 25. Value between 1000 to 25. Values less than 1000. Each subcategory has an identification. No. What is the identification? More than 25, 1000 to 25, less than 25. That's a side heading. Yes or no? That is called identifying characteristic. And that process of subdividing is called as what? Stratification. Each subpopulation is called as stratum. Units under those are called as strata. That's why it's called stratified random sampling. Now, audit efficiency can be improved if auditor stratifies population by dividing it into subpopulation. Efficiency we can increase. How? When we selected simple random sampling, 20 samples we selected, but the value came only 10,000. But we apply stratified random sampling, same 20 number, but 34,000 rupees worth we verify. Efficiency of audit increased or not? Same 20 we are verifying, but output is coming so much. Able to understand? The objective of stratification is what? To select a sample from all parts of the population having different characteristics. Yes or no, it is proved or not? Next. When performing test of details means what? Actual transactions, sales, purchases, expenses. Often stratification is based on monetary value. How we stratified the sales data now morning? How we stratified in the previous class? Based on monetary value. Able to understand? Now, how projection will apply here? Suppose you divided into subparts, right? From each subpart you selected sample, right? Suppose small items 234 were there. Out of which 6 we have selected. Out of 6 we found 1 mistake. 1 by 6 mistake. 1 by 6 we will apply in total 277 population, or we apply total 234. We need to project to that stratum. Suppose generally sampling, how we apply sampling is, suppose out of 100 1 mistake is there. Out of 10,000 how many? This is what projection means. But when we divide this 10,000 into subparts, projection should be made to the total gross population or subpopulations. Subpopulations. So projection should be made for each subpart, and the total projection we should make to population. Understood or not? So the results of audit procedures applied to sample within a stratum can only be projected to the items that makes up that stratum. Able to understand? Every sentence you see how you can correlate. Now, the results of sample from the units drawn from subpopulation are projected to the respective stratum. And finally, in order to draw opinion on the population, auditor need to combine the result of all the stratums to check possible deviation, to check risk of MMS in the whole population. Are you getting it? That's it. So, projected misstatement of each stratum will be combined to consider possible effect of misstatement in the actual account balance or the transaction. Nothing but that is the population. Clear? Now, what is value weighted selection? Value weighted selection is the sample size, selection process, evaluation, everything is in monetary amount. Now, you see, stratification means it's a technical term. Now, in our example, sales data, how is stratified based on monetary amount, based on value? Yes or no? Now, when we divide the strata, when we divide the population based on value, that's actually called as monetary unit sampling, or the technique is called as value weighted selection. We are giving high weight to which items? Large items or small items? Large items. You see, that's why large items only 6 were there. All the 6 were selected. Yes or no? You see, when performing test of details, it is better to identify sampling unit as monetary unit. The auditor will be more focused for large value items because they can result in smaller sample size. The approach can be used in combination with systematic method as well as random selection. Generally, we apply stratified selection. Generally, we apply stratified random. Value weighted selection, we apply with random selection. We don't go with systematic selection, which is most popular. That's what most efficient when using with which method? Random method. That's it. Getting it? Next. Now there is a discussion on sampling risk. Now, by the way, still we have some other methods. What is systematic selection or interval sampling? We divided 277 divided by 20 sample size is equal to 14 is the interval. What is systematic selection? It's a selection method where sampling units in the population is divided by sample size. Total in our sales report, how many sampling units were there? 277 divided by 20. What is the interval? 14. The starting point may be haphazard. The starting number may be haphazard, but it is more likely random. Okay, if at all we select that number by computerized random number. When using systematic selection, the auditor would need to determine sampling units within the population are not structured in a way that sampling interval corresponds with a particular pattern of the population. So what is the sentence? These kinds of sentences, if at all asked for true or false statements, that's it. You're gone. Now, in interval sampling, I am deciding to select every 14th item. Suppose in the company, every 14th expenditure is, let us assume, repairs and maintenance. And when your interval is also 14, you selected 20 samples in expenses. All the 20, what you will get? So your interval should not match with any pattern. Able to understand? The pattern of transaction and the interval should not match. You should take that kind of precaution. Otherwise, see why the reason why you're following systematic selection, because you want to select all the expenditures, all the types. But every 14th transaction is always this one. So automatically what happens? It will become one pattern, only one set of transactions you are selecting. Are you getting the point? Every 10th sale in this company is to so and so vendor or so and so customer. So you are selecting 10 as interval for sales verification. All invoices that you select for sample will belong to only one customer. Again problem. So that's what. Now you see the sentence. So in systematic selection, auditor would need to determine the sampling units within the population are not structured in a way that sampling interval corresponds with a particular pattern of the population. Understood? Therefore, systematic sampling when chosen as a method would be carefully applied, and you can have more than one starting point. Suppose point number 1, 14, 28, 42, 56. Likewise, I am going again. There again, I will put a random number. From there again, 14 I will count. Are you getting the point? Next, monetary. It is nothing but value weighted selection, where the sampling results, everything is in monetary amounts. Haphazard sampling. This has asked for many times, 4 marks question. Getting a stratified random sampling is also asked many times. Haphazard. Haphazard means what? Auditor select the sample without following any technique. The auditor will avoid bias and predictability. We did have other selection. Do we have any bias? No. But we don't use random number tables. Getting it? This method is not superior when compared with other sampling methods. In this method also, every sampling unit will have a chance of selection, but may not be equal. Because I am selecting manually. So how do I know? How do I run computer button correctly, equally? I can't. But if it is given to computer, it naturally selects equally. Able to understand. That's it. Then we have block sampling. Block sampling, I hope you'll read and understand. Getting it? This is easy method. Next, sampling risk. So what is a sampling risk? So what is sampling risk? So sampling risk means what? Risk of not detecting a material misstatement. This is audit risk actually. Risk of not detecting a material misstatement is in fact not audit risk, in fact detection risk. More clear. All these three are interrelated. Risk of not detecting a material misstatement, that is actually detection risk, because of which audit risk will increase. And why detection risk arises? One of the reasons why detection risk arises is sampling risk. So what do you mean by sampling risk? Risk of selecting an inappropriate sample. What is inappropriate sample? What you are verifying in the sample, the characteristics of the sample are completely different from the characteristics of the population. The characteristics of the sample is completely different from the characteristics of population. When you verify the sample, you get one kind of conclusion. But if at all you verify the population, if at all, you will get completely different conclusion. Which means, whatever conclusion I am forming on sample is not matching with population if I verify the population. Example, what are the wrong conclusions that you might get? Getting it? In case of test of controls, what kind of conclusions you will get? In case of test of details, what kind of wrong conclusions you will get? In case of test of controls, risk of over reliance. Another one is risk of under reliance. Risk of over reliance, risk of under reliance. In case of test of details, risk of incorrect acceptance, risk of incorrect rejection. What are they? Risk of over reliance, risk of under reliance in case of controls. In case of details, risk of incorrect acceptance, risk of incorrect rejection. Look, we do verified controls also on sampling basis only. Controls we verify on what basis? Sampling basis. Example of one control is, suppose in this company where I am doing audit, the purchases value more than 5 lakhs. Whenever company want to place a purchase order, where the order value is more than 5 lakhs, this order shall be approved by finance manager and CFO. This order shall be approved by both of them. Only then the order will be entered into the system. Getting the point? Only when this order is entered into the system, we can accept the goods when they are delivered. Suppose if a supplier sent goods to us, in a company, when a supplier sent goods, storekeeper may not have any idea. So when goods came, the other party will tell, sir, your company ordered goods. Storekeeper, what he will do? Okay, sir, accept, and he will give acknowledgement. Naturally, it became purchase, liability. But whether our organization placed order or not, how do we know? So we should tell storekeeper immediately, first, whenever somebody is sending the goods, first receive the goods only when there is an order from our company. Now he need to give acknowledgement of receipt, no? That acknowledgement will not generate without PO, without purchase order. And who is ordering? Not that store person, purchase people, somebody else is ordering. They will order, the data will be entered into the system, and this fellow, when goods received, no. We need to give acknowledgement for goods received, right? When he is entering the goods received, it will ask first question against which PO, which purchase order these goods are received. First you need to map that. Only if we map that, suppose purchase order contain 1000 units, and whereas this fellow sent 1200 units, he cannot accept beyond 1000. He can only give acknowledgement for 1000. Even though he deliver all the 1200, he can give acknowledgement only for 1000. Liability can be booked only for 1000. And this fellow is only giving GRN. Now like this, in the computer, restrictions will be given. This is called control. Now I need to test these controls. How purchases related controls are, I need to test. How do I test the controls? I will take few samples, only check this control. I'll take all the purchases where the order value is more than 5 lakhs. I'll take some 10 purchase bills. Purchase orders more than 10 lakhs or 5 lakhs. I'll cross verify what is the policy. FM, CFO, both should approve. Both are they approved or not, I'll check. This is called test of control. What is this called as? Test of control. Sir, you are actually selecting the invoice and checking. No. Is it not test of transaction? Is it not test of detail? No. This is control checking. I'm only checking that control. Now I felt, yeah, everywhere authorization is perfect. GRN I saw. Yeah, GRN every time whenever they are accepting, PO mapping is done. I saw every controls like this. I tested controls are effective. Then I will take some 100 purchase transactions. Then I will check when the PO was raised, how much quantity, when the GRN was issued, how much quantity, payment slips, and when the voucher was prepared, when the entry was passed in the books, at what value it was passed. This is substantive procedure. What is this? Substantive procedure, test of detail, nothing but the actual transaction testing. Able to understand. In test of detail, the transaction will be tested right from its origin till the end. Whereas in test of control, I will only check that control element. In both the cases, I will check with voucher only. But the objective of verifying is different. Are you getting the point? All of you. Now, in test of controls, when I see the control is working fine, I saw some 10 samples. All the 10 samples purchase, finance manager, CFO, everyone is signing. I felt control is effective, excellent. But actually in reality, whatever samples I selected only, they followed control. In the remaining samples, they didn't follow the rules. In many cases, they didn't follow the rules. Almost 1 in every 3 invoices, they don't follow the rule. 33% deviation is there. But bad luck. Based on the sample I have selected, I felt controls are working very well. Am I believing them or not? Over reliance. Tell me what will happen because of trusting the control too much. I will select lesser sample size for test of details. If controls are effective, I will do less substantive procedure. When I do less substantive procedure, what will happen? The possibility of discovering mistakes will reduce. Now tell me, when the discovery of mistakes reduces, I will not discover mistakes. I will say everything is true and fair, when in fact, so many mistakes are there. Am I giving wrong opinion or not? Audit risk. Understood or not? So that is called risk of over-reliance. Risk of under-reliance. Company transactions are everything perfect. The controls are working absolutely fine. But I randomly selected some 10 vouchers and saw the control. Everywhere it failed. And the fact is, only these 10 vouchers failure is there. Remaining 9,990, they are absolutely fine. But the sample which I selected, based on that only I will go right. The moment I saw out of 10, 5 mistakes, I felt immediately in the population so many mistakes were there. I felt control is not at all working properly. What will I do because of this? I will take bigger sample and I will try to prove so many mistakes, but I will fail ultimately. But because of under-reliance, my audit efficiency is affecting. No. Okay, I may not give wrong opinion. I will do more careful audit, but my efficiency is affecting. No. But because of over-reliance, what will happen? Audit risk will increase. Whereas under-reliance, is there any impact on audit risk? Next, risk of incorrect acceptance. Test of details means what? I will take 100 samples. I verify these 100 samples. I did not find a single mistake in them. Entire GR and PO, everything, 100% vouching I did. Getting it? I verified 100% transaction. Whatever vouchers I selected, I selected in depth. And I did not find a single mistake. Getting the point? I did not find a single mistake. I felt entire population is true and fair. I accepted entire population as true and fair. But in reality, the population is having so many mistakes which are not discovered in the sample. So, am I accepting the entire population of true and fair or not? But which is incorrect. Now, because of this, what happens? Treating that population is free from material misstatements when in fact they exist. Because of this, what happens? Audit risk increases. My opinion may go wrong. Risk of incorrect rejection means what? I am rejecting population saying they are not true and fair. But this rejection is not correct. What will happen because of this? See, the sample I selected found mistakes. I felt entire population is materially misstated. So I said everything is not true and fair. Now, because of this, is there an impact on audit risk? No. So, this is sampling risk and wrong conclusions that you might take up. You see, what is sampling risk? The auditor conclusion based on sample is different from population if at all entire population you verified. Selecting inappropriate sample is also called as sampling risk. Like risk of over-reliance, risk of under-reliance, risk of incorrect acceptance, risk of incorrect rejection. Are you clear? Now, detection risk, I told you, the risk of not identifying mistakes. Will this arise only because of the sampling risk? I may even have non-sampling risk. I may even have non-sampling risk. What non-sampling risk? Sample is correct. The way you interpret only wrong. Yes or no? That is called human mistakes. Or you are misinterpreting sample results. Or you are taking wrong information. These kinds of risk, no. Because of this also you are giving wrong opinion. But this risk is coming from not sampling, other than sampling. That is called non-sampling risk. So non-sampling risk is the risk that auditor reaches a wrong conclusion for any reason other than sampling risk. Non-sampling risk can never be measured. Are you getting it? Next. Finally, whatever sample you have selected, whatever sample you have ultimately selected, you need to apply verification procedures. The auditor shall perform audit procedure, whatever is relevant for the purpose. Audit procedure is not applicable to selected item, then he need to perform on a replacement item. What is meant by this? They do ask all these kinds of questions. For this, no, what I suggest is better read main material here. My main material is there, better read that. We have given examples also clearly. What is replacement item? What is, if replacement is possible, alternative procedure? Unable to apply suitable alternative procedure. All this is little bit bigger discussion, cannot be covered in revision. Verify from the main book, you will understand better after all this. Then we have few more important topics. Now, what are the requirements? Fan on, fan. Yeah. So what SA 530 is requiring? What SA 530 is requiring? First, sample design. How you should have sample design? Which method you should follow? First, understand the purpose of audit procedure and characteristics of the population, and then select the design accordingly. If the characteristics of the population are wide variation, I'll go for stratified sampling. Otherwise, I'll go for simple random sampling. Sample selection. It should happen in an unbiased way. Every item will have a chance of selection. Now, how much sample size you will select? It is that much sufficient to reduce sampling risk to an acceptable low level. The sample size must be such that the sampling risk will be reduced to low level. Sampling risk means the possibility that I may take up wrong conclusions based on sample. That possibility should reduce. If that possibility should reduce means I should check more number of samples. If I take less number of samples, if I discover mistake, I will think in a major items of population also there is a mistake. Very simple. 100 samples I verified. One mistake I found. 5% is the mistake. That's what I conclude on population. I took another 100. Nothing I found. Zero mistake. Now out of 200 till now how many I found? Only one. Now what will I interpret? Only 2.5% error. Able to understand in the population. So as the sample size increases, my prediction over the population will also changes. Able to understand? Now, what factors in examination you may get this question also? What are the factors that you have to consider for sample design? So if they may ask you this also, please read from main material. Don't miss this. Please read from main material. Wherever I told you to read from main material or I say material, please go through that. Now, first of all, can I consider a sampling plan? Can I consider a sampling plan or not? Can I go with sampling or not? It depends upon size of the organization. It depends upon internal control, reliability of books, tolerable error range. In this company, what is the error range possibility? If it is within my toleration level, okay, I can go with the sampling. Suppose if the errors are beyond tolerable limit, better I will not go for sampling. And how much confidence you want? The greater confidence you require, the greater must be the sample size. Same way, we're having another question. What are the factors? What are the factors that affect sample size in case of test of controls? What are the factors that affect sample size in case of test of details? Now here in exam, they'll ask you this question. This kind of question. Very tricky question. Only if you understand entire sampling chapter you can write this. Otherwise you can't. Which of the following is not a factor? Which of the following is not a factor for determining sample size in case of test of details? Option A, risk of material misstatement. Option B, projected misstatement. Option C, expected misstatement. Option D, tolerable misstatement. Which of the following is not a factor for determining sample size in case of test of details? First, you must know meaning for all the four before answering. Getting the point? The answer is projected mistake. And if at all any of you guessed it correctly, don't do festival. Okay, because it can be accidental. Getting it? It can be accidental. What is expected misstatement? What is tolerable misstatement? What is projected misstatement? First you must understand these three. Consciously we should select right answer. Then only you can answer well even for some other question. Getting it? What is tolerable misstatement? It's nothing but performance materiality. Tolerable misstatement means what? It's nothing but performance materiality. Have you seen performance materiality SA 320 definition? Performance materiality means a materiality level set by the auditor at less than overall materiality for financial statements as a whole in order to reduce the probability of undetected misstatements, uncorrected misstatements exceeding the overall materiality. If applicable, performance materiality also means a specific materiality level set for a particular class of transaction or account balance. This is the definition. Not understood, right? So tough the definition was. Getting it? Performance materiality definition is not easy. That is nothing but tolerable misstatement. See, like, I'll give you here a glimpse of SA 320. I'll give you here a glimpse of SA 320. Materiality standard. There are two materialities. One is called as planning materiality. Another one is called as performance materiality. This performance materiality in sampling chapter can be correlated as tolerable misstatement. Tolerable misstatement. Planning materiality is also called as overall materiality. Overall materiality. Once you discover a mistake, first you need to interpret the mistake. What mistake it is? What is the mistake nature? You need to interpret the mistake nature. The mistake is of two kinds. Anomaly or non-anomaly. Anomaly, non-anomaly. Anomaly means, there's again a definition. It's a rate of deviation or misstatement that is demonstrably non-representative of population. This is what the definition is. A rate of deviation or a misstatement that is demonstrably non-representative of population. Nothing but anomaly means non-repetitive mistake. What is it called as? Non-repetitive mistake. This is a mistake which is not representative of population. What do you mean by that? This mistake is there only in the sample I have selected. It will not be there in population. Like how? What is that mistake? Example. Suppose an accountant while entering a transaction of 10 lakhs by mistake typed 11 lakhs. Sorry, by mistake typed, one extra. Out of hurry, he typed one twice and he entered 5 zeros correctly. Getting the point? Will this mistake happen every time? Will this mistake happen? Suppose a 10 lakhs value is recorded as 1 crore 10 lakhs. 10 lakhs worth of transaction is recorded as 1 crore 10 lakhs. I discovered this mistake. Now can I say every 10 lakh entry in the books of accounts is misstated by 1 crore? This mistake is there only in that sample. This is called anomaly. By the way, have you discovered the mistake? What is the mistake value here? 1 crore. What is the mistake value here? 1 crore. 10 lakhs to be accounted as 10 lakhs, but they accounted as 1 crore 10 lakhs. So how much is the mistake value? 1 crore. Exactly. Now this mistake not yet corrected by the company. This is called uncorrected misstatement. This is called as uncorrected misstatement. Now this is the 1 crore mistake. Now this is anomaly. Now based on this, can I project mistakes in the population? No. Are you clear? Now next, non-anomaly. In the control, the company's software, there is a small error. What error is? Whenever goods received note, see like what error they wrote, what program they wrote is, the program what they wrote is, like if purchase order contains 1000 units, maximum GRN can be generated for how much? Maximum you can receive for how much against that order? 1000 only. You ordered 1000 means how many you can receive against that order? Maximum 1000. Now here in GRN, while writing the program, they should write less than or equal to 1000. Able to understand? They ignored that word less than. They used the word equal to. Whenever they are mapping GRN, by default system accept 1000. Suppose if PO contain 1000, system also accept 1000. If PO contain 2000, system also accept 2000. But in reality, how many I am receiving? That system is ignoring. Even if I try to enter 900, system is not accepting. If this kind of error is there in the software, every transaction wherever I am receiving less than ordered quantity, every transaction will be misstated, yes or no? Are you getting the point? Now, can I project this? Yes, I can project. I can use this for projection. Depending upon some mathematical calculations, we can use this for projection because it's a repetitive mistake. What is it called as? Non-anomaly. Non-anomalous projection. We call it as what? Non-anomalous projection. Now tell me, when I say 100 crore might be the mistake in the population, is it corrected or undetected? Is it uncorrected or undetected? Suppose I discovered 1 crore mistake. Based on that, I am estimating 10 crore is the total mistake in the population. Now, 1 crore I discovered, 10 crore I am estimating. This 10 crore is uncorrected or undetected. I have not detected, it's estimated. Are you getting the point? Suppose tell me, when I project the mistake plus when I discover the actual mistake, undetected plus uncorrected. Getting it? I take performance materiality, actual materiality 1 crore. If total mistake crossed 1 crore, it's material misstatement. You have to give modified opinion. If it is 10 times of this, it is pervasive. We have to give adverse opinion. Getting it? Now here 1 crore is the total materiality level, right? And I see here below, I will set some 60 lakhs as performance materiality. 60 lakhs I will set for performance materiality. And triviality materiality, we call it as trivial level. I will keep something called 10,000 rupees. I will tell my team members, if any mistake is less than 10,000, ignore. If it is more than 10,000, reporting differences. What is it called as? Reporting differences. Means we will accumulate all that mistakes whose value is more than 10,000. These are all mistakes we are finding in audit. Now we total it and we take projection. If the projected value exceeds this, no. PM level, if at all it exceeds PM level, no. Definitely there is a chance that actual mistake is more than overall materiality. Able to understand? That's how the concept has been developed. That's how the concept. You can watch my marathon, previous marathon, which I uploaded. In that I clearly spoke about SA 320. Around some half an hour, 40 minutes I uploaded. You can watch that. You'll understand. So tolerable misstatement means how much mistake I can tolerate. If the tolerable misstatement which I discovered is less than performance materiality, it's fine. If at all that uncorrected, undetected misstatement exceed tolerable level, the moment my misstatement which I calculated exceeds a tolerable level, I will have to be very, very careful. I will have to select more samples. Once again, I have to redo the working. Again, it is exceeding tolerable level. I will conclude the entire population is materially misstated. Able to understand? That's it. That's tolerable level. Now, what is risk of MMS? What is expected MMS? What is projected MMS? Very simple. How much samples I should select in purchases? I first verify controls, right? Controls are working fine. When controls are working fine, do I expect any material misstatement? When controls are working fine, will I expect any material misstatement? When controls are not working fine, I expect naturally more mistakes. When I expect more mistakes, I want to discover them. I will increase my sample size. When the risk is high, sample size is high. When my tolerable misstatement is very low, my toleration is very low, I can't tolerate mistakes. Then when I cannot tolerate a single mistake also, my sample size will be high. Okay, so many mistakes, up to this much level I can tolerate, no problem. The tolerance level, if it is very high, sample size will be low. Now, once I selected sample, I applied audit procedure. See, there are so many factors, risk of MMS, expected MMS and tolerable MMS. By considering all these factors, I selected some 100 units as sample size. I verified all of them. I discovered 2 mistakes. One mistake is anomaly, another one is non-anomaly. Based on non-anomaly, now in out of 100, one is, see, it's not out of 100, it's out of 99. Out of 100, one is non-repetitive, ignore it. So out of 99, how many repetitive mistakes you found? 1. Out of 99, 1 means, out of 9,999, how many? Are you getting the point? That mistake which you established as anomaly, exclude it from the projection. From the sample, from the projection, both you exclude. Out of 10,000, minus 1 is a non-anomaly. So balance population is 9999. Out of 100 samples, 1 is anomaly, only 99. Out of this you found another one. So how to project? Only you should project for 9999. This is called projection. Projection is the end result of sample verification. It is not the starting point to select sample size. Understood or not? Projection is something which we do after end of sample verification. After verification, now we will project. Now projection is not a, projected MMS is not a basis for sample size. Is projected misstatement basis for selecting 100 or 120 or 150? Is it basis for me? No. Are you getting the point? All of you. I understand. You didn't study all this. And this is what asked in exams. Next. So, what are the factors that influence a sample size in case of controls, in case of details? I clearly explain few points. You read them later. Getting it? All of you. If I have to discuss that, it will take hours. So projection treatment also just I explain. Getting it? In controls, no, projection is not required. If control is deviated 30%, population deviation for controls is how much? 30% only, because it is expressed as a percentage. Whereas in test of details, extrapolation is required. Anomaly means what? What is the treatment of anomaly? How to evaluate sample results? What are the precautions you should take while applying test technique? So first understand accounting system, internal control system. Identify areas which are not suitable for sampling, first of all, like statutory areas, and planning for sampling methods. All the transaction balances shall be properly classified. Sample size, please determine. Select in unbiased way, and result must be analyzed properly. These are the precautions to be taken whenever you are deciding to apply sampling. Are you clear? I explained you clearly the basics and the medium, like commendable idea about the terminology. Now you can study those concepts which are pending, but study only from the beginning, that too from the main material if you want in-depth clarity. Are you clear? That's it. So this is sampling chapter. Then we have analytical procedure, we'll discuss. So let's start with the analytical procedures. What is this analytical procedure exactly? First of all, this analytical procedure you will come across at two places. In the audit subject, you will come across mainly the analytical procedure introduction at two places. First of all, what are broad audit procedures? Risk assessment procedure, further audit procedure. You see, we have another question on what are various audit procedures through which you can obtain evidence. Inquiry, inspection, observation, confirmation, recalculation, reperformance, analytical, all these are cumulatively applied, not one is to, like it's not, they are not substitutes, understand. There also they use the same word audit procedure, here also they use the same word audit procedure. What are various audit procedures to obtain sufficient and appropriate audit evidence? If the question is regarding evidence context, then you need to write that inquiry, observation, inspection, all that. Getting the point? What are the broad audit procedures? Getting it? Generally this question they will not ask. They may either ask risk assessment procedure, or they may either ask write about test of controls, nature of test of controls, timing of test of controls, extent of test of controls. Can we use evidence obtained in previous audit related to test of controls? Like this they'll ask. Or they'll ask you about, write about substantive procedures, write about substantive procedures related to financial statements closing process, write about substantive procedure as a response to a significant risk. Like this they'll ask a question. Getting it? They will not ask you to write what are all full audit procedures. They'll not ask. Understood or not? All of you? But this context can be tested in correct or incorrect questions. There when you are reading the question itself, you will understand it is about this, not about inquiry inspection. Or if at all they tested correct or incorrect portion in that context, you will clearly understand. Able to understand. Now, what risk assessment procedure includes? What risk assessment procedure includes? What is risk assessment procedure? Definition is different. So here I'll give you risk assessment chapter overview. So what is risk assessment? I told you about an example. You are identifying the risk. And not only identifying the risk, you are quantifying it. You are assessing the risk. Is it a high risk or medium risk or low risk? Is it a significant risk or insignificant risk? You are assessing the risk. You are identifying and assessing what risk? Risk of. Which risk you are worried about? My risk is, if the financials are materially misstated and I have not discovered them, my opinion will go wrong. So this risk only you are concerned with. You are not concerned with any other business risk. You are not concerned with operational risk. You are not concerned with regulatory risk. Correct? So we are concerned with which type of risk? Only the risk of MMS. So identifying and assessing risk of possibilities for material misstatements through understanding the entity and its environment, including internal control. This is the definition of risk assessment procedure. And auditor shall identify risk at two levels. One is financial statement level, another one is assertion level. Now, When I'm looking at the entire company control environment, I'm looking at the entire company governance. There if I find some problems, there if I find some lapses, the top management of the company do not have integrity. The top management of the company do not have commitment towards proper maintenance of records. This indicates risk not only in one or two aspects, but this indicates risk in every aspect. Suppose if production manager is not a good person, is having malified intention. Production manager is he's having so many pressures on him, so he might do a fraud. Now that will affect what? Maximum production records. That's a risk of production record. Company CEO himself is having this kind. Now where he will do fraud? Everywhere. Able to understand? Top management, those charged with governance integrity, that's a financial statement level risk. In fact, this is also called as pervasive level risk. What is this is also called as? Pervasive level risk. Suppose a production department there is some problem, or inventory there is some issue, cashier there is some issue, getting it? Sales team there is some issue, in vendors we have some issue. These risks are what? Assertion level risk. Because if something goes wrong there, only that particular assertion will affect, only that inventory will affect, only the debtor balance will affect. Correct? Sometimes multiple assertions risk together will evolve into financial statement level risk. So see here, auditor will not identify risk at two levels. Whatever risk I identified, I will classify them at two levels. When we find something called financial statement level risk, we will not continue with audit. What we will do? We will withdraw. Getting it? We will withdraw. When auditor finds financial statement level risk, he will definitely cannot continue the audit, because when the risk is at entire financial statements, how can I proceed with audit? Because the management, the accounting records completely become unreliable. The moment financial statement level risk is there, the financial statements prepared by management itself will become questionable. So naturally, I cannot be doing audit. I cannot do audit with that kind of mindset. Skepticism, auditor need not doubt the management. But when he find a circumstance, be alert. That is what skepticism says. Skepticism means what? Be alert. Maintain that alertness. Be cautious. Be careful. Act diligently, carefully. But it is not saying question everything, whatever management is doing. Be doubtful about the management. Don't trust the management. They are dishonest people. No. With this attitude, don't start the audit. But if you discover such a kind of attitude, if you discover that the management may manipulate every record, obviously with that kind of doubt, you cannot do the audit. Understood? So most of the risk that we find in our real life is assertion level risk. Assertion level risk means what? We discussed risk assessment example. Laborers, casual laborers. So here in employee wages payment, they may do a fraud. Assertion level risk. In inventory, scrap related fraud they can do. Assertion level risk. Now we need to design our audit procedures. We need to design and implement, or we need to plan our nature, timing, extent of audit procedure to address these risks. Able to understand? This is called response to the risk. Are you getting the point? Now they may ask you, what is the auditor's response to a significant risk? That's a question given in the SA 330. How auditor will respond in case if we identified significant risk. You see in the documentation evidence chapter part 3 you will find. That is the controls related discussion, audit procedures. So auditor should generally get external confirmation. Whenever there is a significant risk, wherever possible, auditor should get external confirmation. That's what the main agenda. Are you clear? So this is what there in the risk assessment process. Now how do you identify the risk? Including internal control. You will test the control. I clearly explain how test of controls happen. How test of controls will happen, I clearly explain. And so when an auditor will be testing the control, remember controls means what? It means a process. It means a process. At the end of the day, the door will be closed. At the end of the day, campus main entrance door will be closed and locked. It's a process. It's a control. Why? To protect these assets. Safeguarding of assets. Have you seen that objective? Internal control, what are the objectives? 5 objectives. Protect the safeguarding of assets. Increasing efficiency and effectiveness of operations. Why we are fixing timings? In order to increase efficiency and effectiveness of the ultimate operations that we are taking up. Able to understand. Ensuring that the financial statements are reliable. And by implementing all this, you are preventing frauds and errors. Or by installing the CCTV cameras, whatever, you are able to detect if any frauds went wrong. Correct? Huh? And any process that you design in order to comply with law and regulation, those are also form part of internal control objectives. 5 objectives. Yes or no? Reliability of financial statements or reliability of financial reporting. Prevention and detection of fraud and error. Efficiency and effectiveness of operations. Then safeguarding of assets. Compliance with laws and regulations. These are the objectives of internal controls. Now you have these internal controls 3 types. Internal controls based on where they were implemented, how they were implemented, 3 types. Operating controls, compliance controls, financial controls. We don't have discussion much in depth on operating controls and compliance controls. That's again a very big subject. We have a discussion on financial controls. What are IFC? What are objectives of IFC? Now here we discussed 5 objectives. No? In that, efficiency, effectiveness of operations is there. No, remove that. Because operations will be taken care by which controls? Remaining all 4 objectives will come under financial control objectives. That's why you see financial controls will have 4 items only, which are part of IEC objective. Understood or not? All of you. Now, internal control based on nature, they are again 3 types. Preventive control, detective control, corrective control. Controls, there are processes which will prevent first fraud. If any fraud happened, management would have implemented some process to detect the frauds. Once the fraud is detected, how to correct it? They'll have a corrective mechanism. Like, complaining with policies and recovery actions, all this. These are all corrective controls. Understood. Now, these controls, even though management is implementing, ultimately, these processes are something who will implement? Human beings. They may prone to mistakes. Even though the control is highly effective, the humans will do. Who will implement the control may do a mistake. Yes or no? Human judgment is involved. These are all limitations in the control. Which means no matter how organization implemented the control, there are some inherent limitations. Internal controls will only give reasonable assurance about the objectives of the entity. Not only auditor, even management has implemented so many processes, right? Those processes will only give reasonable assurance about achievement of entity's objective. Understood? This is what there in that entire chapter. So how we do risk assessment? What is risk assessment? What are all the factors to be considered? What is significant risk? Getting the point? Now what is internal control? What are limitations in the control? What are the components of internal control? Components of internal control, the topic is there even in your information technology. There are five components. It's a COSO model. Yes or no? Exactly the same model is what followed in audit. COSO model. In final, we have a chapter called risk assessment. There we will discuss COSO model, COBIT model, COCO model. There are various other models. Able to understand? So this is regarding the risk assessment and internal control chapter, which exactly deals with. But I'm telling you sincerely, don't always try to study 100%. At least keep 20% buffer. Ignore, keep it at last. Only if you study rest 80%, 100% perfectly. Yes, I am the best in this entire 80%. Then only go to the remaining 20%. Rather than attempting 100, 110 marks, averagely and securing 20, it is better to attempt for 70 and secure 50. And easy also. Attempting for 70 and securing 50 is quite easy. That's called efficiency. Getting it? Nowadays you see, hey, it's okay, let me write one answer. Something I'll write, at least half mark they'll put. They'll not. Getting it? They'll see the suggested answer or they'll see scheme of valuation instructions and they'll check your answer and he will know, he will clearly identify that you put some story. Getting it? So this is not a university exam where if you fill the paper, you will get the mark. Are you clear? Now, so once again, analytical procedure we are discussing. Okay. So what is there in the analytical procedure? Sorry. What are various audit procedure? Risk assessment procedure, further audit procedure. Now what is risk assessment procedure? Risk assessment chapter is what? Clearly explaining. Now I just told you brief. Now what this risk assessment procedure includes? It includes inquiry and inspection, observation, analytical procedure. These three. Risk assessment procedure includes what? They'll ask you this question. What is risk assessment procedure? Definition. What risk assessment procedure includes? It includes inquiry and inspection. The matter is different. You will find this matter in, risk assessment. You inquire management, you inquire audit committee, you inquire internal auditors, you inquire so and so. You inspect minutes of the meetings. Through this, you will understand what are all the risks the company is facing. Observation. Look at the process, how everything is happening. Look at the inventory go down. Look at the, factory. Next, analytical procedure. Apply logics. Now I told you yesterday, in the previous session also, when we visited the warehouse, when I saw in one of the big room, scrap is kept, immediately I got a logical doubt. What registers in respect of scrap they are maintaining? And management replied, for every sale we are recording. What about input? What about inflow? Sorry sir, we don't maintain any record for generation. Record for generation, inward, no records were there. Only sale related records were there. Now, I found the risk, no? How did I find the risk here? By analytically thinking about scrap. Able to understand. Immediately, I applied analytical calculation. I roughly brought production records. Okay. How much inflow totally during the year? Production. Multiplied by what is the normal loss percentage or abnormal loss percentage? Applied. This much is the total scrap generated during the year. I applied ratio analysis technique. This much scrap is what generated during the year. And this much you are mentioning as sold. And how much is there inside the godown? Check it out. Sales value plus closing stock value is equal to generated stock value. Correct? I saw it is not matching. Now, I did analytical calculation, right? That will come under substantive analytical procedure. Right now, whatever I did will come under substantive analytical procedure. Substantive analytical procedure means I will take actual data, on that I will apply analytical calculations. Understood or not? So the word analytical procedure is very broad. Analytical procedure in the context of risk is different from the analytical procedure in the context of substantive procedure is different. That's why if you see here, the word clearly used is substantive analytical procedure. Many will ask me, what's the difference between analytical procedure, substantive analytical? Not this. If at all student ask me this, I will be very happy. My God, student is thinking very good. But student will ask me difference between these two. What is the difference between substantive procedure, substantive analytical? This doubt, who will ask, who did not understand anything about audit? Now what I feel, when I get this kind of doubt, I will not clarify, because if I clarify them, they'll ask another doubt. Substantive procedure means it's completely actual transactions, details and analytical. That's what I'll test. Now immediate second question. Sir, what do you mean by actual transaction testing? If I tell them purchases, loss, P&L, all the testing, again they'll ask one more doubt. So that understanding as a whole is important. Now you understood this, the gap. So analytical procedure word will come as part of risk assessment. The word will come as part of substantive. But under substantive procedure, we will not simply call it as analytical. We will call it as substantive analytical procedure. First what I will do, scrap related sales verification I will do. Scrap sales I will do. Test of details. I will verify that. Getting it? Then I discovered, see whatever records are available related to scrap sales, test of details. I did that. That is also substantive procedure only, correct? But is it analytical procedure? Scrap sales were there, invoices were given, sale invoices were given, GST calculations, everything was there. How much was sold, how much was delivered, what is the amount mentioned in GST returns, all that I verified. This is what actual details I am testing. That is called as what? Test of details. But when I saw ultimately after testing all this, I got this doubt. What about input production records? That is not there. Now how much you sold? How much you generated? There might be some fraud. Yes or no? Then I applied logical calculations based on actual records. That is called substantive analytical. Substantive means reality. Getting the point? Underlying substance. Getting it? On that actual data, if I apply analytical procedure, and that is called as substantive analytical procedure. Analytical procedure as part of risk assessment is something that we generally do as beginning of the audit. Generally we do risk assessment at beginning. But remember, risk assessment is not one-time process. It's a continuous process. You have to be continuously alerted to identify new risk. It is not one-time activity. Today I will do risk assessment. Or tomorrow even if I find new risk, no. Yesterday it's over. Can I say that? So it's a risk assessment is a continuous process. Audit planning is a continuous process. Have you seen like this the sentence? Audit planning is a continuous process. It is not a discrete phase of an audit. Rather a continuous and iterative process. You might have seen. Iterative means what? Repetitive. Are you clear? Next. So this is where we generally come across analytical procedure. Now, what exactly in analytical procedure I will do? You know, if we did risk assessment, no? That is something similar to analytical only. That is something similar to analytical procedure only. Fine, anyhow, let me take even more better example. Scrap example I told just. How do I find total scrap generated? Records not there. Okay, let it be. But production records there, no? How much raw material entered into the production, that is there, no? Correct? You may get it out. Sir, what if company did not maintain that as well? That means cost records they didn't maintain properly. You will qualify in CARO report. Are you getting the point? Okay. So, production records will be there. Take production inflow of raw material multiplied by normal loss percentage, abnormal loss percentage, scrap generated during the year. Now, what is the value applied? You will get some value. 15 crore is the value of the scrap generated. How much is sold? 10 crore. So, in the godown 5 crores there, no? We went and physically verified. Only 2 crore is there. What happened to 3 crore? I will have to investigate. Okay. I will have to investigate about what happened to 3 crores. I will immediately talk to the top management. Sir, based on our analytical procedure, we discovered 3 crore deficit in the stock. So what is your explanation? He asked me what is my basis. You are saying 3 crore difference, sir. I agree. Okay. On what basis you are saying 3 crore? I showed my normal loss workings, all that. Then the director replied me, the company main director replied me, sir, normal loss is not that percentage, sir. It's lower percentage. We have implemented new machineries and all very recently. The normal loss percent has substantially came down. So now it is not that much. You might have given a wrong data by our production manager. He is not familiar with all this. He is only good at production, not good at records. Then I asked him, what is the proof for what you are saying? He showed me all the proofs. Then again I took revised values and I discovered that the total value is 12 crore 50 lakhs. Now what is visible? 10 crore is sold, 2 crore stock is visible, 50 lakhs difference is there, which is an estimation difference. In estimate, some difference might come now up to 5-10% difference is acceptable. Correct? If it is more than that, it is unusual difference. It is something unusual difference. If it is unusual difference, what I did right now? Investigated. Now look at the analytical procedure definition. Analytical procedure means what? Analytical procedure means evaluation of financial information through analysis of relationships among both financial and non-financial data. And what is the purpose of analytical procedure? There is a question here. What is the purpose of analytical procedure? Analytical procedures may help identify unusual transactions, unusual events, unusual amounts, unusual ratios, that might indicate matters that have audit implications. What is this? Now, what I exactly did here, since they are saying records were not maintained, I did analytical procedure. I analytically calculated what is the stock generated. Correct? Based on that, how much is sold, how much is lying, I eliminated. I found 3 crores difference, which is not usual, which is unusual. Able to understand? When I find 3 crore difference, what I do? When auditor finds difference in analytical procedure, how do auditor investigate? We have a question on that. Investigating analytical procedure. If auditor identifies fluctuations that are inconsistent with the expected value, I expected totally 15 crore. Company showed only 12 crore. 3 crore is difference. Expected value, there is a difference of how much? 3 crore by significant amount. Then auditor shall investigate by inquiring management. I inquired management in our example. I went to director and asked him why 3 crore difference. There is a fraud. Immediately what director replied? No sir, some percentage has been changed. You have taken some wrong percentage. Something he replied. Whatever he replied, did I keep quiet? I asked him proof. I verified that additional proofs. Yes or no? Performing additional audit procedures. This question itself has been asked for 4 marks previously. Write about investigation of analytical procedures. Investigating results of analytical procedure. Understood or not? All of you. So, analytical procedure means nothing but we always have some estimation. Analytically, logically we will calculate. See, for a debtor, some particular account, very simple. You know how we do analytical procedure. You might have understood previous year, current year analysis, comparative analysis, yes or no? I am looking at balance sheet P&L. I am looking at balance sheet P&L. So, there are some sales. So 10 crore, last year 8 crore. Some other income, current year 2 crore, last year 1.5 crore. So this is the totals. Then expenditure, last year 9 crore, current year 9 crore, last year 7 crore. Getting it? Operating expenses, last year 5 crore, current year 12 crore. So likewise I am finding. Now tell me, between all this, which you feel unusual? Between these amounts, current year, last year, where you felt the difference is too heavy. Exactly. Now this is called unusual difference. Now say, okay, this is in a pattern. Okay, generally sales have been increased, other income is increased, purchases also increased because there is an increase in sales. So naturally production would have been increased. I understand. But why operating expenses increased so almost more than double? Suppose last year if it is 5 crore and current year if it is 7 crore, I may be not having any doubt. But last year 5, current year it is 12. Unusual difference. Yes or no? Now, when I find this, I investigated. Okay, what is this 12 crore consist of? They gave me breakup. Okay, like auditors remuneration, electricity expenses, fuel expenses, telephone expenses, repairs and maintenance expenditure. Now, repairs and maintenance expenditure, last year it was 1 crore, current year it was 7 crore. Remaining all are more or less similar. Remaining are more or less 20-30% similar. But this is huge. 500% difference. Last year 1 crore, now current year 7 crore. How come? So, now again I verified. What is the breakup for 7 crore? What is the breakup for 7 crore? So, what is the breakup for 7 crore? I verified. Okay, like for January, April month, May month, June month, July month, August. Likewise, month-wise breakup I asked. In all the months it is 10 lakhs, 15 lakhs, 12 lakhs likewise. But somewhere in September month, it was around 5.5 crore. Which means, which month I will pick out? September month. Something is wrong with September month. I opened it. And I saw date-wise. On one particular date, September 14th, example. Getting it? Some 5 crore was debited. What is this 5 crore I saw? It's actually a spare part has been purchased. For a machine, a spare part has been purchased. What is this spare part accounting treatment? If it is integral part of the asset, it has more than 1 year life, or it has minimum life of the asset. We will have to capitalize and depreciate. Or if spare part has a separate useful life, and that can be used even without the asset, then we will separately mention it. Correct? So this is actually a capital expenditure. But how the company charge it to? Where they have charged it to? P&L account they charge it to. Now how I found the difference? By doing inter-period analysis. Getting it? Nothing but analytical procedure. Suppose, traditionally what I'll do, I'll take 100 samples. Expenses also I'll take 100 samples. If this error came in my sample, I'll discover. But if my sample does not cover this item, this expenditure item I did not see in the sample, I will feel every expenditure processed. Signature is there, payment made correctly, TDS deducted, GST, everything is correctly accounted. Super. But only when I apply logical analysis to the amounts, I will discover something is wrong. And this is most important procedure in audit. What is most important in audit is not everyone that we discuss. This is most important in audit. You need to look at the amounts logically. Getting it? There is a movie, Tani or One. Read between the lines. Have you seen that? Yes or no? So you must read between the amounts. So why that there is a difference? Last year this much, current year this much. Why? Sales are this much. Why product? Why purchases was low? Why employee cost was high? Last year employee cost was some 15 crore. Current year employee cost was 25 crore. Last year income 100 crore. Current year income 120 crore. Turnover. There is only 20% increase in turnover, but why employee cost has increased almost by 60%? Understood my question? Company operations have increased only by 20%. But why employee cost was increased by almost 60%? On 15, if I apply 60%, 9 crore. 9 plus 15 approximately 24 to 25. Correct? Last year turnover is this much, current year is only by 20% increase. But why suddenly employee cost increased? Some fraud might have been there in the HR. Some money laundering transaction might be there. So what happened? I asked management, sir, last year, current year, we have declared 50% increment, sir, for every employee. Because of which there is a huge hike in the salary when the increment was declared. Is it declared at the beginning of the year? Is it declared at the end of the year? If it is declared at the end of the year, how come salary will increase? It will increase in the next year, not in the current year. I will question in all these logical dimensions. Every question I want logical, every amount in the balance sheet, every amount in the P&L, I want to understand logically is it correct or not. Okay, vouchers were there, amounts was paid, that is okay, fine. But logically, are they seeming correct or not? Only when I apply analytical procedure, I will discover frauds. If we do not apply analytical procedure, we will not identify unusual transactions. Understood or not? All of you? That's it. So with this introduction, we can start with analytical procedure. So analytical procedures encompass means what? Covers investigation that is necessary for fluctuations, relationships that are inconsistent. What do you mean by relationships that is inconsistent? Turnover increased only by 20%. Why employee cost increased by 70%? Understood or not? The relationship between turnover and employee cost is similar, no? Especially in a service industry, employee cost will directly reflect turnover. Able to understand? With other information, or it is differing from expected value by a significant amount. If auditor identified fluctuations or relationships which are inconsistent with other relevant information, or the relationship is differing, the fluctuation is differing from expected value by a significant amount. Understood? For each term the example I gave. Clear? Now what is the objective of audit procedure? Ultimately we want to obtain evidence through analytical procedure. So we will design and perform near the end of the audit, which help the auditor when forming overall conclusion as to whether financial statements are consistent with the auditor's understanding of the entity. Now I look at logically how to understand this organization, whether whatever amounts I verified are the matching with logicality of my understanding. So that is what the objective of analytical. Remember, we will not only do at the end of the audit, we will be doing throughout the audit, analytical procedure. Now, what in analytical procedure we will check? We will compare prior period data. We will also compare the existing data with anticipated data. We will compare with similar company data. Yes or no? So what are all the examples of analytical procedures having consideration of relationships? Like they have given few examples, like non-financial information, financial information, like number of employees, payroll cost to turnover. That is one relationship. Okay. So among elements of financial that would be expected to conform to a predictable pattern based on entity's experience, such as gross margin percentage. Like every year you can predict how much company will grow. Getting it? So that is expected value. Now actual growth rate is actual sales value have not grown by expected values. So I will naturally focus on that differences. Understood or not? Next. So thus analytical procedures may be segregated into client and industry data comparison, prior period data comparison, client versus actual versus budgeted comparison, an auditor determined expected results. Client data with auditor expectations, and client data with expected results using non-financial data. So this can be asked. What analytical procedure includes? What kinds of comparisons analytical procedures we will do? You need to write all these points. 4 marks question. Understood or not? What is the purpose of analytical procedure? We want to use comparisons. We use relationships to assess whether account balance, other data appear reasonable. I used a comparison of last year, current year. I found repairs and maintenance appears not reasonable. Last year 1 crore. Last year 1 crore. Why this year 7 crore? It's unreasonable. Yes or no? These helpful in detection of unusual affairs and mistakes in the accounts. Correct? Through that repairs and maintenance example, I discovered how I discovered a capital expenditure is debited to P&L. Next. Like examples I have given, establishing relationship that exists between certain balances included in balance sheet and statement of P&L and comparing them with those existed in the previous year. Repairs and maintenance I compared with last year. Reconciling physical balance of assets with relevant data. Obtaining statements from banks, debtors, payout, creditors, and reconciling with relevant balances. I will cross verify. These are all analytical calculations. Confirmations for outstanding incomes and expenses by preparing reconciliation statements, and they have given various other examples. Now, when we do analytical procedure, we may do at planning phase, we may do while doing the audit, that is called testing phase, or we may do at completion phase. Mainly at planning stage, analytical procedure we do as part of risk assessment procedure. At planning stage we do analytical, right? As part of risk assessment procedures we will do this. Yes or no? Why I do at planning stage? We want to identify areas of potential risk. Yes or no? By indicating aspects of and developments in the entity's business which is previously unaware. We don't know this kind of relationship. We don't know until we apply analytical. We never get a doubt. The information will assist the auditor in determining nature, timing, extent of his audit procedure. The moment I went to go down, the moment that they told me that scrap registers were not available, I immediately get a doubt. I will put in my audit plan, scrap, senior article will verify. I will also verify because there is a non-main inadequate records, which is a fraud risk factor. Able to understand? Analytical procedures will use both financial data and non-financial. Do analytical procedures depend only on financial data? Do they depend only on non-financial? Both. We compare non-financial to financial. You might have done in FM ratio analysis. That is entirely analytical procedure. That is entirely analytical procedure. One example I'll give you from the ratio analysis. Debtors turnover ratio is there, right? Last year debtors turnover ratio was 5. Current year debtors turnover ratio was 6. Getting it? Now 360 by 5, you get some approximately how much more? 72. Correct? Whereas 360 by 6, 60. Correct? Last year debtors turnover ratio 72 days worth of credit sales were outstanding. Whereas current year 60 days worth of credit sale was only outstanding. First of all, what is the actual credit period policy? 40 days. Then why this much worth of debtors were outstanding? Why this much worth of debtors were outstanding last year? Okay, forget last year, summer auditor. Current year I am the auditor, right? When the company, debtors is, when the company credit period is 40 days, out of total sales, divided by 6, if, debtors turnover, how I calculated turnover ratio, turnover divided by trade receivables is equal to 6 it came. 360 divided by 6 is equal to debtors holding period came. So debtors credit period is actually how much? In the order 60 days. But management is saying me 40 days. Then why for me logically 60 days coming? What happened? Sir, huge credit sale was made in the last year, last month, sir. Okay, then if that is the case, okay, fine. Ratio might have given a different result. But sales every month even. Every month sales are even, more or less same. Then why this much variation? Some long outstanding debtors might be there. Some long outstanding debtors. What do you mean by long outstanding debtors? They were liable to pay from long ago. Is it indicating provision for doubtful debts? Whether entity created a provision, cross verify, not created, you discovered mistake by this. This is called aging analysis as well. Understood or not? FM ratio analysis is used for this only. Ratio analysis is not for, like this thing. This is for understanding and interpreting the results. Understood? By using how much fixed assets I generated this much turnover, fixed asset turnover ratio. I compare with another company. Another company fixed asset turnover ratio 10. My company fixed asset turnover ratio is 6, which means I am underutilizing my assets. That company with the same investment, 10 times turnover they generated. Even I invested same amount, but I generated only 5 times turnover. Understood or not? Fixed asset turnover ratio means what? That is how we understand. Every ratio has a meaning. Are you getting it? IRR is a ratio, right? Internal rate of return. My company IRR is 17%. Another company IRR is 25%. Shareholder is questioning me. I will move to that company because I am getting better return. Understood? So these are all various understandings. Next. What is substantive analytical procedure? Substantive procedures includes test of details and analytical procedure. Getting it? And therefore, analytical procedures which are one part of substantive audit procedures are also called as what? Substantive analytical procedure. Now, when will you use this analytical procedure? It is based on auditor's judgment. Ultimately, what is the objective of using this analytical? To reduce audit risk. Ultimately, my opinion should be right. My opinion should not go wrong. The auditor may inquire management regarding availability and reliability of the information in order to apply substantive analytical and result of that analytical procedure. The auditor should consider the following factors for substantive analytical procedure. This question has been asked in the last attempt, I think. So last of that before attempt. For 4 marks they have asked. For 4 or 5 marks. What are the factors the auditor should consider? What are the factors the auditor should consider for substantive procedures? First, in order to apply analytical procedure, first I must need some background data. Yes or no? And remember, I can apply analytical procedure only if I can disaggregate the data into multiple parts. Example, you see, first in the P&L I found operating expenses huge variation. Then I asked breakup. Then they gave me breakup for each operating expenditure, repairs and maintenance. That alone is not sufficient. I want to break up month wise. Now tell me, originally between 2 items I found difference. Then this is aggregate data. Now I disaggregated or not? I split it. Again I split it into months. This is called disaggregation. The more disaggregation that you can do, the better result you can get. Understood or not? The more micro level you can go inside, you can understand the problem that, strongly. That's what. So the degree of disaggregation available that directly affect degree of usefulness of detecting material misstatement. So account type, this is little lengthy point, not required. Source. Some class of transaction tend to be more predictable because they are numerous similar transactions, whereas some transactions which are non-routine and estimation involving significant class of transactions, these items may not be predictable over time. And predictability. How far you can predict a particular transaction? Will it move in a particular pattern? Suppose, can I predict cases against the company? Legal cases. Last year 10 cases, current year 12 will come. Can I say that? Exactly. So where you need to apply analytical, where you should not apply analytical, you must have, understanding, the judgment. And remember, analytical procedure will give evidence for whether everything is accounted completely. Is the value reasonable or not? Will analytical procedure give me idea about ownership? If I apply logically, can I understand building who is owner? I'm not astrologer. Correct? So in analytical procedure, we do continuously what? What can go wrong analysis. Same risk analysis principles we apply. Understood or not? So what are the techniques? Trend analysis, ratio analysis, reasonableness test, structural modeling. What is trend analysis? In the last exam, this was asked. The analytical procedure implies analyzing fluctuations by comparing current year to prior data. What is this technique is called as? Briefly explain. 4 marks question, last attempt exactly. Yes or no? They asked about trend analysis. Trend analysis is commonly used technique. It is nothing but comparison of current data with the prior balances or with the trend in 2 or more prior periods. Here, the auditor evaluates whether current balance is in line with the trend established in the previous. Whatever past trend is there, current same trend continued or not. Generally, trend analysis I can apply on rental expenditure, salary expenditure. Even turnover I may not apply always. Sometimes I can apply if the industry situations are normal, I can apply. Suppose between 2019 and 2020, can I apply trend analysis? Because of the COVID situation. So I can't trend, I can't estimate the trend. Yes or no? For medical industry, the trend is extremely high. For remaining industry, the trend is extremely low. Able to understand? Ratio analysis. Ratio analysis means what? Ratio analysis is useful for analyzing assets and liabilities, revenue expenditure account. An individual balance sheet account is difficult to predict on its own, but its relationship with another account is more often predictable. What is that sentence meaning? Yeah. So what is that exact meaning? See, this is Reliance company. Tell me what is plant and machinery? How much? Can you predict on its own? You can't. But if I give you turnover of the machine is this much, asset turnover ratio is this much, can you predict the third item? Exactly. So an individual balance sheet item or individual P&L item cannot be predictable on its own, but its relationship with others is often more predictable. Ratios can also be compared to the ratios of different entities or prior period. For example, auditor can review GP ratio for the current year. The auditor can compare the GP ratio with the earlier years or GP ratio with other company, why this company is performing low, where the company is lacking exactly, maybe there might be some frauds in that area. Understood? Simple, you want to identify something unusual, where this company is not going right. I just want to figure out where it is going wrong and why it is going wrong. I want to figure out. If it is because of some fraud or error, material misstatement, that is concerned for me. Are you getting the point? Then reasonableness test. Reasonableness test means we applied no repairs and maintenance. Last year it was 1 crore, current year it was 5 crore. How come? Unreasonable. Are you getting the point? It is not only trend. I felt 5 crore repair is unreasonable. What 5 crore worth of repair on a single day? It's unreasonable amount. I investigated and I found it's a spare part and I found it's a capital expenditure wrongly debited to P&L. So this is not something trend analysis. We do not rely upon past period, but we rely upon non-financial data. Getting it? By using non-financial data. Example, turnover 20% increased. Salary cost 70% increased. It feels something unreasonable. Able to understand? So is it reasonable or not? Next. These tests are generally more applicable to income statement items and certain accrual and prepayment accounts. In other words, these tests may be made by reviewing relationship of certain account balances to other balances in order to identify reasonableness of the amount. Interest expenditure against interest bearing obligations, like how much I borrowed, how much I am giving. Next, raw material consumption to production. Raw material consumption to production is also a technique of ratio analysis. But this here, the main objective is it appearing reasonable or not? Management is telling me 10 crore worth of inventory was sold, 2 crore worth lying. How much is generated? Totally they are saying 12 crore. Is it reasonable? Is it correct? I want to check it out. So that is called reasonableness test. Structural modeling is a statistical tool, so nobody is using structural modeling in audit. Even in reality also nobody will be using this. This structural modeling technique might be useful in non-financial fields, probably not in financial fields. Can I use only analytical procedure as a single substantive audit procedure? I will not do test of details. Can I use this only analytical procedure as a pure audit procedure, substantive procedure? If test of controls are highly effective, you can apply just analytical procedure, logically check everything seems right. Controls are fine, no, which means actual transaction will be done well. Just see logically everything appears fine. If logically everything appears fine, process is correctly followed, why you have to check internally again, go? It's waste of time, focus on some other area. Are you getting it? Analytical procedures will be applied either alone or in combination with test of details. So, determining suitability of particular analytical procedure for given assertion, what is the assessed risk of MMS? All this you need to take into account. If the risk of MMS is low, controls are operating effectively, generally we can just apply on only substantive analytical procedure. Further, if you want to apply only analytical procedure, how far the data is reliable? If the data is very accurate and reliable, based on analytical procedure, whatever decision you are taking will also be reliable. If the data is moderate, then better don't apply this alone. Actual transactions also you have to test. Now develop an expectation of recorded amount. Some scrap value totally recorded 12 lakhs. What is expectation? 15 crore. And evaluate whether expectation is enough to identify a misstatement that individually or when aggregated with other mistakes may cause financials to be materially misstated. So develop an estimate, develop an expectation and compare with the actual and see how far it is detecting a material misstatement. Have you seen all this? I feel like you have never gone through all this. In sampling also your faces are similar. In documentation evidence chapter also same expression. Now, suitability of a particular analytical procedure. This question also asked many times. Which method of analytical procedure is suitable? Like trend analysis suitable, ratio analysis suitable, reasonableness suitable. Which method of analytical procedure is suitable for a given assertion? I want to check employee cost, whether it is reasonable or not. Should I apply reasonableness test? Should I apply trend analysis? Should I apply ratio analysis? It depends on what? Auditor's professional judgment of how a method will discover a material misstatement. If a particular method discovers mistake, remaining methods are not discovering mistakes. Which is suitable method? The method which detects misstatement is a suitable method. Sometimes an unsophisticated method. Sometimes an unsophisticated method may be a most reasonable, suitable method. Example, I called one employee. I told him close your eyes. I opened chits, purchases, sales and all. Pick one chit. He picked sales. I investigated sales. Fraud was discovered. Is it analytical, intellectual? Nothing. Exactly. So, substantive analytical procedures are first of all generally more applicable to large volume of transactions that tend to be predictable over time. Comment. They'll ask you the question. You need to write this answer. Analytical procedures are generally more applicable to large volume of transactions that tend to be predictable over time. Comment. 4 marks question. You need to write the below continuation. The suitability of a particular procedure will depend upon how effective it will be in identifying a misstatement that causes financial statements to be materially misstated. Sometimes even an unsophisticated model may be effective when discovering a material misstatement. Different types of analytical procedure provide different levels of assurance. Which method is suitable for the given assertion is a matter of professional judgment. It's okay, that's enough. Now what factors you will consider on reliability of data? Now you see, what are the factors to apply analytical procedure? First point we discussed is availability of reliable data. One of the factor is only if the data background is available correctly, then I can only apply analytical procedure and happily proceed. Now, how to say whether data is reliable or not? How to say whether data is reliable or not? From source, from where the data is obtained. If the data is obtained from independent sources, generally it is more reliable. How far the data is helpful for comparability? How far the data is relevant for this assertion? What are the controls over preparation of the data? This is the most important thing. What are the controls over preparation of data? This itself can be asked as a 3 marks question. One of the factor for ensuring reliability of background data for applying analytical procedure is controls over preparation of the data. What are the points you will consider? Only this point that can be asked. Able to understand? If accounting records, employee payroll records are 100% accurate because they were completely automized, they were completely electronic, now nobody can change, means controls are effective. Now I will take that data and apply my logical analysis to it. Then my result of analytical procedure will be more accurate. Understood or not? So like that we need to discuss. This is actually 5-6 hours chapter approximately. This paragraph is not required. Investigating results we understood. How analytical procedure helps in drawing overall conclusions. How analytical procedures will help auditor in concluding overall. The conclusions drawn from the results of analytical procedures are intended to corroborate conclusions formed during the audit of individual components. When I originally verified purchases, controls I saw, everything is effective. I took 100 samples, then everything was completely rightly processed. So that originally I felt when I conducted audit, normal substantive procedure and normal compliance procedure, I felt purchases, everything is true and fair. Now I apply logically everything. Now both should match. No. Logically also I should feel yes, they are completely reliable. Actual verification also should be completely reliable. So this analytical procedure helps to draw reasonable conclusions on which he will base audit opinion. Because of analytical procedures, you will identify previously unidentified risk. Correct? Normally when I apply controls evaluation, normally when I check actual transaction, vouchers and all sample, I may not identify any problem in that. But when I logically think why this account is unusual variation, then only I discovered. Correct? In such circumstance, whenever auditor is identifying previously unidentified fluctuation or risk, please revise your auditor's assessment of risk and modify further audit procedures accordingly. This can be asked as a true or false statement. This can be asked as a correct or incorrect statement. When auditor has performed analytical procedure, the auditor may come across previously unidentified or unrecognized risk of MMS. Even though the auditor need not revise his further audit procedure or risk assessment procedure, incorrect. As per SA 520 analytical procedure, because of the result of analytical procedure, if auditor is aware of previously unidentified risk of MMS, the auditor shall revise the auditor's assessment of risk and modify further audit procedures accordingly. Understood or not? Now consideration specific to public sector entity while applying. In public sector, when you are applying analytical, you will apply propriety principle as well. Whether the expenditure incurred is reasonable expenditure or not, government audit propriety principle is there. That also you should keep in mind. That is what this entire point is saying. Clear? That's it. So that's regarding analytical procedure. Almost all the topics we have covered. If at all you think analytical procedure is having 3 or 4 topics, come out of it. Every chapter I'm seeing, like many of you don't have that much connection with 100% syllabus. Hardly you are smiling for 40% syllabus and crying for 60% syllabus. Which means you focused only on 40%, which is easy. Getting it? Like I'm telling no. See, why all these things are happening is very simple. 4 or 5 years before, whoever teachers were there, they were only continuing even today. And there's nothing wrong. But as long as they don't update, they should not continue. 3 or 4 years ago, I can say 5 attempts before, May 2019 before, the auditing paper was 1 or 2 papers. Quite easy. Getting it? They used to ask straight question. They never test a question from analytical procedure and sampling, you know. Previously, we never seen. We don't even know that these chapters were there, you know. When we are writing exam at final, we don't know that these chapters were there. Inter also, we don't know that these chapters were there. All we know is company audit, documentation chapter, standards, different types of entities, government audit. We have vouching and verification. You have items of financials, we have vouching and verification. That's it. We only know that chapters and we only read from that and we secure 50-55. But if you read only those chapters, you will secure 25 for sure. Getting it? But we require 50 plus, no, minimum. In order to secure 50 plus, you need to have comment on audit report, documentation, sampling, fraud. We don't even know that there is a chapter called fraud, you know, earlier. First of all, in audit, misstatements means fraud, error. We don't know that. That's the level of coaching that time. Getting it? So people are not updating themselves. Still, many are in the old assumption. Like, okay, auditing means, kuch bhi nahi. It's very easy. No, not. Just check last attempt paper, that last attempt, last 5 attempts papers you check. Any paper you take of your choice. The questions are very, very clever. The questions are very in-depth. They don't ask you, hey, tell me what are the methods in analytical procedure. No. They'll give you a sentence. What is this method? Briefly explain about the method. That's how the question is. So, I just opened you entire syllabus before you. What is there exactly? Now it is your turn to prepare. Getting it? And I gave you for every chapter a clear-cut idea how it works. How the chapter works, I clearly gave you an idea. Because we don't have, it's not a regular video, we have time restrictions. Moreover, your exam is near. It's not possible for us to discuss 100% in depth. Getting it? So with this, analytical procedure chapter is over. So let's begin the revision of risk assessment and internal control. You know, this is the biggest chapter, which is almost as equal to audit report chapter. We have audit report, that is the biggest chapter, risk assessment and items of financials. Of course, these 3 chapters are very big. And these 3 chapters are having equal weightage, which are having 18 to 24% approximately the weightages. And if you look at risk assessment chapter, it typically has, I can say 60 questions. It typically has 60 questions. Straight away, 50 questions of various topics like risk assessment, internal control, automated environment, materiality, internal financial controls related to financial statements, documentation and reporting, and SA 330, where we gave it as a standard, which equals to some 10 questions. And actually, there is a chapter called, initially, there is a chapter called, in the initial, I'll show you just a minute. This chapter is there, right? Completion and review. Inside this completion and review, 450 and 265 standards were there, but we don't discuss it as part of that chapter directly. We discuss it as part of risk assessment. So for me, though as per our subject index, it is given as part of 4th chapter, I discuss this as part of risk assessment topic. So now in this revision, what am I going to cover? I will be discussing this risk assessment topic, especially 1 to 6 questions. And I will be discussing 3 or 4 important questions in internal control. And I will be discussing automated environment. IFC, this is very important from exam point of view. 265, 450, I'll be discussing. Materiality,
I will be attaching as a continuation to this, I will be attaching my previous version video. I'll be attaching my previous version video on the materiality topic where I took a best example, which is enough from exam point of view. For materiality alone, my colored notes I will be giving you. Okay, you can download this materiality related colored notes in my website, in our website, rest of a CACMA website. You go inside that, like I'll show you right now. So this is the rest of a CACMA website. You go to PDF resources, open CA final. Not CA final, sorry. CA inter you open. So, you open group 2, notes and this thing, paper 5. Here you will find for 530, 520, I've used color material, right? Here itself, I will add 320 material also. 320 material also I'll be adding here. So that alone you have to use. See, right now what you will do is, as anyhow exams are just a few, 3-4 days away. Getting it? What you have to do is just watch this class and leave. What I generally tell my students is, leave this entire chapter as choice. Rest all other chapters, even strategy chapter also, I ask people to leave it. So these two chapters, strategy and this, especially these two chapters, leave it as a choice. Rest all other topics you prepare the best. Believe me, you can attempt for 90+ marks for sure. Whatever it is, whether it is MCQ form or descriptive form, you can attempt 85 to 90 marks for sure, the best. If you want to watch this particular class, just at least watch. Don't sit and stress yourself reading this entire chapter. It is one of the toughest chapter what I feel. In this, risk assessment topic, IFC topic is somewhat easy. 265, 450 are also easy. But internal control, materiality, 330 are extremely tough. Automated is also a bit easier. Getting it? So straight away, let me start with, let's begin with risk assessment topic. So what is risk assessment and internal control? In this, risk assessment and internal control are predominantly dealt under 315. Predominantly 315 is the standard which actually dealing with. 315 is the standard which actually, see, there is a link. Every one of us know, right? The audit procedures are two types. One is risk assessment procedure. The other one is called as further audit procedure. Risk assessment procedures means, by the way, in 330, substantive procedure part I will discuss. In 330, substantive procedures part I will discuss. Risk assessment procedure is what covered under 315. What is 315 saying? Identifying and assessing risk of material misstatement through understanding the entity and its environment. Identifying and assessing risk of material misstatement through understanding the entity and its environment. Identifying and assessing the risk. What do you mean by identifying and assessing risk? First we do risk assessment. Documentation chapter introduction, you see, we do a risk assessment. We do go to the entity. We try to see what are all the risks that are possible, where and all mistakes can happen. Is there any fraud risk factor is there? We try to identify risks, risks of error, risks of fraud, risks of material misstatement. We identify risk. Why we should do this risk assessment first of all? Ultimately, whether we do risk assessment procedure, whether we do further audit procedure, the objective is to reduce audit risk. The objective is to reduce audit risk. We are doing audit, right? We are doing audit. What is the objective of our audit? To give opinion on the financial statements, whether they are free from material misstatements or not. Whether the financial statements are free from material misstatements. So we want to give an opinion. But we all know we will never verify 100% of the financial statements. We never verify 100% of the records and documents. We do sample, we do take sample, and based on the sample we give opinion, which means the opinion whatever we are saying, yes, the financials are true and fair. No, financials are not true and fair. Our opinion can go wrong. Correct? Our opinion might go wrong. Why it might go wrong? Because you are giving opinion on sample basis. Alright, there are thousands of transactions. You just take 100 samples, and based on that you are saying entire thousands of transactions are right, where you did not actually verify. This is the risk we have. What is the risk we have? The risk we have is risk of expressing inappropriate opinion. Risk of expressing inappropriate opinion. Inappropriate opinion, especially when the financial statements are materially misstated. When the financial statements are materially misstated, you are giving me inappropriate opinion. Tell me, when the financials are materially misstated, what opinion we should give? Obviously, modified opinion. When the financials are misstated, you should give modified. but you are giving unmodified opinion. You are giving what? Unmodified opinion. This is what actually the standard says. So when the financials are materially misstated, where you have to give a negative opinion, you are giving positive opinion. Now tell me, why you gave unmodified opinion when the financials are materially misstated? Because though the financials are materially misstated, I did not discover material misstatements. I didn't discover them. If I don't discover mistakes, what generally I assume, if there are no mistakes, I assume everything is right. That's why I gave unmodified opinion. Otherwise, why will I give unmodified opinion on the financial statements which are materially misstated? Because I assume, since I did not find a single mistake, financials are true and fair. When the financials are materially misstated, you gave unmodified opinion because you did not detect, you have not detected material misstated. Why you didn't detect? What is the reason? Because I am suffering from detection risk. Because we auditors suffer from detection risk. Why detection risk? Sampling risk is there? No. Because I do audit based on sample. How do you expect me to discover all the mistakes in the entire population when I am verifying only sample? Okay. Because we are doing audit based on sample, we can't identify all the misstatements happened in the financial statements. That is called as sampling risk. That itself leads to detection risk. Sometimes whatever sample we selected, right, some vouchers and all, they were completely fabricated, they are completely forged, they are completely fraudulent, but we don't know they were fraudulent. We don't know that they are duplicate. Sometimes the evidence available itself we convince. Remember, in audit, the evidence that we get is convincing evidence, persuasive evidence, so not conclusive in nature. We can never get conclusive evidence. It's only persuasive in nature. The evidence that we get in audit is persuasive in nature. The audit evidence can never be conclusive. You getting it? Persuasive means what? We just convince and then, yeah, we just convince. We just convince. Yes, everything is true and fair. Purchase document is there. eBay bill is there. The goods received note is there. Okay, fine. Which means purchase transaction probably is genuine. We just convince. Getting the point? We really don't know whether really happened, whether this transaction really happened or not. We don't know. That is the reason our assurance is a reasonable assurance, not absolute assurance. We have already seen why we give reasonable assurance in our nature, objective, and scope of audit chapter, inherent limitations of audit. So detection risk is one of the important thing why there is always audit risk. Why detection risk? Because there is a risk of material misstatement. Because there is a risk of material misstatement, financial statements get materially misstated. There is a possibility, and you fail to detect. You fail to detect the material misstatement, and that is the reason why there is an audit risk. If someone asks me why there is an audit risk is because financial statements gets materially misstated. For sure there is a risk, and for sure I will not be discovering all those misstatements. I will not be discovering is called as detection risk. So because financial statements get material misstated and I will not be discovering financial statements which are materially misstated, because I did not discover, I will give unmodified opinion. Tell me, on a financial statements, even though if I do not discover material misstatement, can I give an adverse opinion? I want to give adverse opinion. You need to give reason, right? In audit report we have seen, whenever you are giving a qualified opinion or adverse opinion, you must clearly explain the reason in the basis for qualified opinion, basis for adverse opinion section. If you don't give reason, how come you give? Just like that, you can't give adverse or qualified opinion. You can only give adverse or qualified opinion only when you have evidence. If you don't have evidence, you can't. Able to understand. So there is a detection risk, a risk of MMS, and there is always there is a detection risk. Getting it? So because I did not find any mistake, because I do audit based on sample, I don't have any other option. Since I did not discover any mistake, I will give unqualified opinion. We are giving unqualified opinion to all the companies that you see in the real market is because it's not the financials are absolutely true and fair or completely true and fair, because we failed to detect material misstatements. Because we are not detecting mistakes, we end up giving unqualified opinion. Able to understand. You know, if at all you give adverse opinion, no, suppose you gave a financial statements adverse opinion, everything is wrong, there is no risk. Audit risk is zero. Why, sir? Why? The definition of audit risk, if you see, audit risk means risk of expressing inappropriate opinion. I'll show you from the book. The risk of expressing inappropriate opinion when the financial statements are materially misstated. If the financials are materially misstated, you are giving unmodified opinion. In other words, expression of unmodified opinion in a situation where modified opinion is suitable. Suppose you actually financials are genuine, but I am a very, very pessimistic auditor. I found few mistakes, just a few mistakes, but financials as a whole are good. But I'm a very pessimistic. I'm a very, true conservative mentality. Just because I found so many few mistakes, I directly said financials are not true and fair. Don't believe. And I told reasons also. And many investors, they looked at my audit report, they ignored my report and invested in the company. They lost money later on. And now everybody is coming and asking me, hey, what auditor, what are you doing? Immediately I'll reply, what? Hey, that's why I gave financials are not true and fair. You trusted their financials even though I say everything is bad. How come you come and blame me? So if I say everything is wrong, no risk at all subsequently. But what if tell me financials are materially misstated, but I said everything is true and fair. Tomorrow if some big fraud was detected, everybody will come and question me. Hey, what you did? You said everything is good, but there are so many frauds. Their audit risk is getting it. So what is the consequence of audit risk? Reputation of auditor would be damaged. Reputation of auditor would get damaged. It will also lead to regulatory action. So to avoid these kinds of unpleasant circumstances, what we have to do in order to reduce, so what is your object? So audit risk will be there. So what you need to do? You can't eliminate it too. You can't eliminate. The only way, the only thing that is available is you have to reduce the risk. How to reduce the risk? Try to discover as many mistakes as possible in the financials. Try to do audit scientifically. Try to do audit strategically. Try to do audit statistically, analytically. Apply analytical procedure, apply sampling techniques, apply powerful techniques, try to discover mistakes, do risk assessment, try to figure out where and all things can go wrong, do risk assessment, do further audit procedure, do risk analysis. Getting it? So the auditor has to perform audit in such a way, audit risk is reduced to an acceptably low level. What is acceptably low level? Tomorrow, suppose I gave unmodified opinion because I did not find any mistake. Tomorrow, a big fraud detected, regulatory authority coming and asking me, hey, what are you doing? I showed them, look this, sir, look at my working paper. So much work I did, so scientifically I did my audit, statistically I applied sampling techniques, very strategically I planned the audit, performed the audit, we educated our team, this much team members, these many days we spent, we tried our best to discover. In spite of this, we failed. Now tell me what we can do. We are suffering from inherent limitations, right? That is called acceptable level. If at all you are able to prove that you are innocent with the help of working papers, that's audit level. That is the acceptable level of risk. So, that's what. So they may ask you an example. So in example, they may ask you what is the meaning of audit risk? What are the consequences? What audit risk does not include? It can be asked as an MCQ. What audit risk does not include? Audit risk does not include where you are giving modified opinion. Financials are not materially misstated. Financials are actually true and fair, but you give modified opinion. That is not risk. Further, audit risk is a technical term related to business, audit process. It is not related to business risk. Suppose some clients are leaving me and going. That is not audit risk. That is auditor's risk. Next. So what are the components of audit risk? Risk of material misstatement and detection risk. Audit risk is a function of these two risks. What is risk of MMS? It is a risk that financial statements are materially misstated before audit. Before audit means ignore audit. Forget about audit. There is a possibility that financial statements, books of accounts contain material misstatements. Yes or no? That is called risk of MMS. Getting it? It simply means there is a probability of frauds, probability of errors in the financials before the auditor started the audit. Now, for example, what are the examples of misstatement? They'll give you a question. What is risk of MMS? Give you examples. So charging capital expenditure to revenue, difference in disclosure requirements. You are disclosing something but not as per applicable framework. Inappropriate accounting policies, booking fake expenses, understating inventory, overstating items, whatever it is. Now, whatever the risk that we identify. So what we need to do? First, we need to identify risk. First, we need to try to identify where and all mistakes can go wrong. So where and all mistakes happen, where and all things go wrong, there I will give more attention. There I will plan my audit. There my audit strategy will be diverted. There I will plan more works, in-depth works and all. So whenever I do risk assessment, whatever risk I found, whatever something go wrong, getting it, something can go wrong. If I find something, I will try to check, is it a financial statement level risk or is it an assertion level risk? Risk is at two levels again. The risk, whatever we are classifying, we classify that at two levels. Actually, in reality, we classify the risk as high risk, medium risk, low risk. This is at assertion level. At assertion level, we subclassify risks at 3 levels: high risk, low risk, medium risk. But risk itself is classified as 2 types. I'm not talking about I'm not talking about 2 levels actually, 2 types: financial statement level risk, assertion level risk. What is it? Financial statement level risk. Overall financial statement level risk that relate pervasively to financials as a whole and potential effect many assertions. Suppose CEO and finance manager are fraudulent guys. Suppose in a company, the CEO and finance manager and the accountant, both 3 of them are relatives, 3 of them are with malified intentions. They are very cunning, very cruel, very, like they're cheaters, fraudulent cheaters. Like they were having so many pending cases on them. In fact, that is the kind of people, tell me, where they will do fraud in the entire books of accounts. You don't know. They may do fraud in everything, purchases, sales, everywhere they might be trying to do fraud. They might be trying to manipulate records. That risk is called as financial statement level risk. Suppose I am doing an audit of warehouse. I'm doing an audit of warehouse alone, inventory audit. In inventory, some control is not proper, where there is a possibility of theft of some material. Theft of material is there. So material theft possibility is there. So existence inventory, existence assertion risk. Existence assertion risk, that is called assertion level risk. Generally in most of the audits that we find is assertion level risk. Now existence of inventory, there is a possibility of fraud, right? What is the level of risk? What is the potential? High risk, low risk? What is the possibility? What is the likelihood? Is it high or low? What is the likelihood? So that is called assertion level risk. So the assertion level for class of transaction, account balances and disclosures, these are determined. Assertion level risks are identified to determine nature, timing and extent of further audit procedures. Now you see, first we do what? Risk assessment we do. Then we plan our further audit procedure. What are further audit procedures? Compliance procedures, substantive procedures. Substantive procedures, test of details, substantive analytical procedures. Further audit procedure is what 330 standard exactly talking about. 330 is what, response to assessed risk. Response to assessed risk. Where you assessed the risk? You assessed the risk as per 315. Okay, you assess the risk now. What will you do? I will plan and perform the audit. That is your response. How do you plan and perform? Look at my further audit procedures. That is what the link between 315 and 330. Getting it? So, assertion level, if you identify risk, you consider assertion level risks and plan and perform the further audit procedures. So, this evidence gives auditor expression of opinion. This enables the auditor to express opinion so as to reduce the audit risk to an acceptably low level. So, what are the components of risk of MMS? Again, now, why risk of MMS? By the way, okay, detection risk understood. Mistakes will be there, but we will not be identifying. That's why detection risk. One of the reason is sampling risk. Another reason is non-sampling risk. Various reasons are there why auditor cannot detect misstatements. Just a minute. So, why auditor cannot identify material misstatement? There are so many reasons. Fine. Why misstatements in the financial statements? Because inherent risk. One of the reason is what? Inherent risk. Another reason is what? Control risk. In exam, they may ask you, what is inherent risk? Give you examples. Inherent risk is there, and here 2 examples were also given. So you have to write these 2 examples. What is inherent risk? Possibility, susceptibility of an assertion. That could be material. The possibility of an assertion of a class of transaction account balance to a misstatement. Possibility of an account balance or transaction lead to a misstatement, which is material, either individually that assertion or combination with other misstatements before consideration of controls. First of all, forget about controls. In a company, suppose company is purchasing goods. So many employees are involved in purchasing of goods. There is a possibility that these employees can book a dummy purchase and they take money from the company. Manipulation, misappropriation of asset. There is a possibility that in the purchases, employees can book a fake purchase invoice, fake manipulation of records, and get cash from the company, encash that purchase. This is a risk. But this risk, employees cannot just like that do it because there are controls. Company will implement controls to mitigate this risk. Inherent risk means forget about controls. How things can go wrong. In purchases, how many ways frauds can happen. In sales, how many ways frauds can happen, errors can happen, risk can arise. In how many ways? Inherent risk is by default what is the risk in every business? By default, what is the risk in purchases? By default, what is the risk in sales? In a company, how purchase is being processed? What are the steps involved in purchases? What are the steps involved in sales? Getting it? So that is inherent risk. Now that's why every company will do, more than you. I'm telling you, companies are concerned about this risk because it is their money at the end of the day. At least we are just auditors. It is not our money. Getting it? Even if whether some fraud happened or not, we are not affected much. But their money, company owners, they want the business to be happen without fraud. Most of the companies, I'm telling you, especially private companies. So there won't be many shareholders also. Directly, their owners themselves are shareholders. Directors themselves are shareholder. So they want every record, every pakka, every transaction should be genuine. Getting it? They can't let people do fraud. So inherent risk assessment will be primarily conducted by the companies itself. No, what they do risk assessment. They identify where and all frauds can happen, where and all errors can happen, where and all mistakes can happen. What they do, they devise internal controls there. They devise controls there. Okay, you want to purchase. Purchase can be only from so and so seller. Purchase, if at all you want to purchase at this value, you can't place order. You need to take my permission, director permission. Only if director give permission, it can be. Only when the goods are received, it should be entered only through this software. Only inspection, my another person will come and check. Like this, we will put so many controls. We will give so many controls, so many processes. I can't take more in depth here because in my regular class and all, I'll be showing all this. Purchase piece. A risk control matrix and all I'll be showing, which is actually very interesting. But now since it's a revision, it's not correct for us to see all that. So there is always a risk before checking, before implementing controls. There is always a risk that a particular transaction will have a chance of being misstated. So, and inherent risk, it is obviously high for some assertions, than for other assertions. Then examples. There are large number of business failures in industry. Therefore, assertions in financials in such industry can carry. So, in some industry, risks will be different. In another industry, risks will be different. So, the recording of accounting standard provides guidance on some complex issue which might not be understood. Sometimes company may not understand how to recognize revenue as per one's accounting standard. So they blindly recognize whenever amount is received. There is a risk of overstatement of revenue. This is also a risk. So what control company implemented to mitigate this risk? That's why companies implement controls. Company implement policies and procedures to mitigate these risks, to prevent these risks. So what is control risk? Okay, fine. So many risks were there. Purchases, so many possibilities of frauds and errors can happen. Sales, so many possibilities of frauds and errors can happen. But what company did, to prevent these frauds, to prevent these errors, company has developed, company has designed, company has implemented some processes. Everybody, whoever is purchasing, they should follow this process. Everybody, whoever is selling goods, they should follow this process. While accounting the transactions in books of accounts, follow this process. While making payment, follow this process. Everywhere company has implemented processes. That's called internal control system. Why controls? So that frauds can be prevented. Errors can be prevented. Anybody, whoever is doing whatever they're doing, they should follow the same process. If at all people are doing as per the process, we can have a control. Whoever do some fraud, we can immediately find out. Such a kind of processes were designed and developed and implemented by the company. There is a possibility that process can fail. Yes or no? Control, control very good. But there is a risk that control is not effective. Control is not working. Control risk is the risk that misstatements could occur. That could be material, misstatements could occur in transactions, balances or disclosures, whatever, which could be material. That will not be, these mistakes will not be prevented. These mistakes will not be detected. These mistakes will not be corrected by internal controls. Internal controls by nature are three types: preventive controls, detective controls, corrective controls. So the risk that the internal control system is not efficient to stop from happening any material misstatements, material mistakes in transactions, balances are not being stopped by controls. That's a control risk. So obviously by default financial statements get materially misstated. Somebody will do fraud, inherent risk. To prevent them, controls were implemented. Sometimes that controls failed. Sometimes, because tell me, at the end of the day, process has to be followed by humans only, no? Humans can deviate from the process. Now humans can violate through collusion and all. Because of these two risks, ultimately financial statements get materially misstated. Why financial statements get materially misstated? Purchases and sales and all, why are they materially misstated? Because by default there's a possibility something can go wrong and our controls there not working effectively. Our controls are not working effectively. So these are the reasons why some risk of MMS will arise. So there is an inverse relationship between control. This is not required. Not required. Leave it. These every point in this material is important. Of course, every line, every para is important because these can be asked as an MCQ, true or false statement kind MCQs. There's an inverse relationship between control risk and efficiency of controls. If the controls are efficient, risk is low. If the controls are least efficient, control risk is high. So logical. What are the examples of control risk? So they'll give you a question. What is control risk? What are the examples? You have to write this answer. What is the detection risk? It is a risk that audit procedures will not detect misstatements that exist, which are material. Getting it? So detection risk comprises two types of risks again, sampling risk and non-sampling risk. One risk is because of the samples. Another risk is because auditor's judgment. Auditor might take a wrong decision. That is non-sampling risk. So examples of detection risk. This itself can be asked as a question. Be careful. Now ultimately whatever it is, risk is a matter of professional judgment. What appears risky for you may not appear for somebody as risky. What risk that you will find in a process, somebody may not find the same risk. Getting it? When you show me a purchase process, I can figure out, okay, here these things can go wrong. Out of my experience, out of my knowledge, out of my expertise, whatever. Somebody, when they look at this process, they may discover different types of risks than me. Risk is a judgmental. Getting it? Audit risk is a function of risk of MS and detection risk. The assessment of risk is based on audit procedures necessary to obtain evidence. The assessment of risk is a matter of judgment. You cannot precisely measure the risk rather than a matter capable of precise measurement. You can't measure the risk. 50% risk, 40% risk, 49% risk. You can't. So we do risk of MMS combinedly. We don't generally look at inherent risk and control risk separately. We just look at combinedly. Getting it? I think better I'll show you once this just as an example. I'll show you. When we are doing audit, like this, we do a risk control matrix. We develop what? We develop something called risk control matrix. Purchases. A purchases. What is the risk? Unauthorized vendor. Unauthorized vendor is a risk. Now, company, control they have implemented. This is inherent risk. This entire thing is inherent risk. Okay, risk is there. What company is doing? They implemented controls. They implemented some control, some process. When they have to purchase, they have to follow some process, rules and regulations. Okay, so for this risk, they have implemented this control. If this control is working effectively, this is inherent risk. If this control is working effectively, there is no control risk, which means the risk of MMS is very low. If the risk of MMS is very low, I can discover any frauds and errors very easily. If the risk of MMS is low, detection risk is high. So it requires lots of discussion again. Let's not go deep. So what is the relationship between risk of MMS and detection risk? Inverse. Risk of MMS and detection risk are inverse. If the risk of MMS is low, you can easily identify fraud. If the risk of MMS is high, it is difficult for us to discover all the mistakes and all. That's it. So next. So write about identifying and assessing risk of MMS under 315. The auditor has to identify risk. Whatever the risk you identify, please classify. Is it a financial statement level risk or is it an assertion level risk? A particular assertion related. Suppose purchases have so many assertions: completeness, cutoff, occurrence, occurrence, measurement, disclosure, presentation and disclosure. So many assertions were there. Which risk it is affecting? Which risk? Getting it? Suppose if there is no purchase order. Purchase order, there is a control called purchase order control. So whenever a company placing orders, first they have to maintain list of orders they made. Then how many orders executed ultimately, how many pending orders were there, like that the company should have a control. Suppose if this control is not there, what happens? How many purchases were made during the year? All the purchases were accounted of during the year. We will not have clarity. Getting it? Which means here whether purchases are completely accounted or not is the doubt. I'm not doubtful about entire purchase. I'm doubtful about are they completely accounted. Completeness assertion. So yeah, whatever the risk we identify, no, the risk is two types: assertion level risk and financial statement level risk. So we identify, then assess it. Assessing means what? Is it a high risk? Is it a low risk? If it is high risk, no, we give more further audit procedures we do. Getting it? Ultimately, why are we doing it? To minimize the audit risk to an acceptably low level by properly planning and performing the further audit procedures based on risk assessment procedure. So auditor have to identify what can go wrong by checking related controls. You see here, in a risk control matrix, no, okay, in purchases this can go wrong. So what control is there? So auditor has to consider what can go wrong by considering related controls. And so what is risk assessment procedure? Typically speaking, now tell me, what is risk assessment procedure? What it includes? In risk assessment, no, we talk to people, we inquire management, we inquire people, we inquire employees, we inquire internal auditor, we inquire lawyers. Getting it? We inquire top managements, to understand how the financials are prepared. We inquire internal auditor. So during the year, whatever internal audit they did, know whether management is satisfactorily giving them all the answers correctly, whether internal auditors find any mistakes and all. We ask employees to evaluate appropriateness of accounting policies. We talk to accountant to ask him whether accounting policies are followed correctly. We ask in-house lawyers to provide information on frauds, legal pending cases and all. We ask marketing people about company strategy, sales trends, everything, how business is happening. We talk to risk management people to understand what are the risks that are there in the financial reporting. Getting it? We talk to IT people. What are the changes happen to information technology? What are the processes automated? What are manual processes? And we also do analytical procedure. Analytical procedure we do as part of risk assessment procedure. We also do analytical procedure as part of substantive procedure under further audit procedure in the name of substantive analytical procedure. We do analytical procedure at two places. One we do at risk assessment, another one we do as part of substantive procedures. So this analytical procedures you can read on your own, because I already gave in part 3 analytical procedure video, so you can watch that. Then another way I do identify risk is through observing the entity processes, how the sales are happening, how the purchase is happening, how production is happening, how inventory, how the warehouse is being maintained, how accounting records are maintained. I'll observe, I'll inspect records. Through the observation and inspection also I can find risk. See, how I do risk assessment, whatever I'm doing, they were giving names to it. If I'm talking to people, they're calling it as inquiry. If I'm looking at any records, they're calling it as inspection. If I'm looking at some process, if I'm observing something, they're calling it as observation. If I'm logically thinking how it is happening, that's called analytical procedure. So risk of material misstatement includes, risk assessment procedure include these items. So they may ask you a question, what is risk assessment procedure and what it includes? Give some examples of risk assessment procedure. They'll give you what is risk assessment procedure. This is the definition. What it includes: inquiries, analytical procedure, observation. Sometimes they'll give you specifically only observation. Observation and inspection is one of the important element of risk assessment procedure. Briefly discuss about it. So they'll give you a question on this. Next. Materiality I'll be discussing later. At last I'll be discussing. Then materiality we will be discussing at last. What do you mean by understanding the entity and environment? What do you mean by that? Like SA 315 standard heading, you see. Identifying and assessing risk of material misstatement through understanding the entity and its environment. And so understanding the entity and its environment means what? First, understand what is the industry to which the company belongs to. Telecom industry, telecom company, regulatory, telecom regulatory, other external factors, applicable framework. Though it is a telecom company, for them Schedule 3 is only applicable. Getting it? So what do you mean by relevant industry factors? Relevant industry factors means what? What do you mean by regulatory factors? What do you mean by external factors? They gave breakup. Getting it? Industry means industry conditions, like how competitive it is, who are the suppliers, who are the customers, what are the technological developments, 5G and all is coming in telecom. Getting it? Industry in which the entity operate give rise to specific risks. So in telecom, they'll be having so many liabilities that they have to pay to lawmakers. Telecom regulator, they have to pay. There is a possibility that they may not recognize that expenditure in the books of accounts. So specific risk relating to industry will be there. Regulatory, relevant regulatory. Look at the regulatory environment, like applicable financial reporting framework. So examples, what are the examples? Are there any specific accounting practices for telecom companies? What is the regulatory framework? Is there any regulation that significantly affect our company's operations? Getting it? Look at the taxation, government policies, other external factors, general economic condition, how is it? Interest rates, how is it? How the financing options available to this company, like inflation and all, how it is affecting this company. Getting it? So these are all external, these are all important. These are all we do for going concern assessment, especially. As a part of going concern, we do check all this. Next, another entity, nature of entity. So understanding the entity and its environment. Entity means what? Nature of the entity, what business they are doing, who are the owners, what is the governance structure, what are the investments the entity is made, what is capital structure of this entity, how it is financed, equity, debt, how, mixture, how. So what matters, what are the examples? We mainly look at business operations. From what? Telecom company, they'll be getting revenue from selling prepaid and postpaid plans, all that. Various products and services like data services and all, location of production facilities, investment activities, financing activities, financial reporting such as accounting principles and revenue recognition. So these are all various examples of nature of operations. Another thing, what is understanding the entity and environment? Third point that we need to understand what? We need to understand how the entity is selecting and applying accounting policies. And we also have to understand what are the entity's objective, what is this company mission, vision, what are their strategies, what are the risks that the business risks that the entity is facing. So for that they have given some example. They'll give you this itself as a question, 4 marks question. Telling risk assessment chapter is not easy. Every student, no, I have seen like at least 30-40% of the students are running behind this chapter, considering this is a high weightage. Not only high weightage, this is a very complex chapter. It's very lengthy, complex also at the same time. By the time you study this topic, in the same time you can revise half the syllabus in audit. You can revise so perfectly half the syllabus in audit. Now immediately some students say, sir, what if this question comes in compulsory? So what? It's okay. You target about attempting remaining 80 to 90 marks of the paper. You target to attempt 80 to 90 marks of the paper, enough. Your paper is for 120. Getting it? What if it comes in MCQ? Okay, you'll be losing 3-4 marks. Getting the point. But rest of the 80 marks you're attempting, right? In your hand, right? We are worried about 20-30 marks that we will be losing, rather than in our hand that we have 80 to 90 marks, whatever is in our hand, to protect it. We are not worried about to protect it. We are worried about losing that 20-30. That's why I always tell 3/4 strategy is one of the safest strategy. If you're very strong in 70% of the syllabus in audit, I'm telling you, you will be getting 55 plus. If at all you want 70-80 in audit, then that's a different story. Next. So the auditor has to look at the measurement and review of entity financial performance, how the financial performance of the entity is. So why understanding the entity and its environment is important? Like, of course, without understanding how the entity, what is the entity, in which environment it is working, how can you plan the audit? How can you identify where and all mistakes can go wrong? Where and all mistakes can happen? Where you need to give more focus? Remember, the time available for audit is very limited. We will not do audit throughout 365 days. No, we do audit for 50 days or 60 days in a year totally. Within this 50-60 days, 365 days business. That too, the company is having business across 20 states. So many branches, so many stores, so many receipts, so many books. How do you verify all that? So understand what company is exactly doing. Understand how they are doing business. Understand where things can go wrong. So you plan the audit properly. Give focus to risky areas. And this understanding is a continuous process. This can be asked as a 4 marks question. Whatever question till now I told, this can be asked, this can be asked. They were all asked in the past. In risk assessment, some student asked me, sir, can you give important questions? Every question is important. Show me one question in this chapter that has not been tested earlier. Every question is tested. It depends upon the paper setter mind. So when he's reading, if at all he felt something is very important, something is very challenging, he will test that. So obtaining an understanding of the entity, including controls, is a continuous process. It is not, see, risk assessment and all, we don't do just one time and do further audit ultimately. We do risk assessment continuously. When we are doing further audit process also, we will switch on our mind. Something can go wrong. Something can go wrong. Skepticism has to be maintained throughout the audit. So assessing risk is a continuous process. Assessing risk of MMS, selecting and application of accounting policies, are they appropriate or not? Identifying areas where special issues or special focus is necessary. When analytical procedures, developing expectations. So we should logically analyze the data, how the rental expenditure should be. We should develop an expected value and compare with the actual value. Are they matching or not? So that's it. With that, risk assessment topic is completed mainly. One segment only we have completed until now, not fully. Almost 40 minutes we spent only on one topic, that is risk assessment. Risk assessment is over. And again, 31, 32, 33 questions were there. I think they were also we'll just observe it. We'll just observe it. You know, again, whatever risk we identify, there will be something called significant risk. In the risk that we identify, there will be some risks which are significant risk. What is a significant risk? Significant risks are those where higher likelihood of occurrence, higher magnitude of potential misstatement, the misstatement that going to arise right because of this risk is so big, higher chances of that mistake. The auditor's assertions affected by significant risk, a higher risk. So the auditor assessed the assertions affected by significant risks as higher inherent risk. So if at all any particular assertion is affected by significant risk, we generally classify it as high risk. When we classify it as a significant risk or high risk, what we do? We do in-depth audit there. We do take bigger samples. We do evaluate more. We investigate more. Now, in exercising judgment, whether a risk is a significant risk or not, what points you will check whether a risk is a significant risk or not? If it is because of fraud, if the risk of fraud is there, that's a significant risk. Complexity of the transactions. If it is a transaction with related parties, what is the subjectivity involved, especially accounting estimates and all, high subjectivity is involved. Getting it? Whether the transactions are outside normal course of business, they are not normal. A normal day-to-day transaction is different, exceptional transaction. Non-routine transactions are unusual. Getting it? Because either it's the size of the transaction is so big. Generally, a company will sell 10 products or 20 products. Suddenly to one customer, the company sold 1,000 products. That's an unusual transaction. Judgmental matters that may give rise to accounting estimates with high uncertainty. Judgmental matters where you will develop an accounting estimate for which significant uncertainty is there. No, every point in this material I'm telling you is important. There is nothing that we have to leave. If somebody tells you this is a very short notes, you can read and go and write, don't believe it, because questions are framed very practically. Either study in depth or leave it, this chapter. This is what I recommend you. You see, hardly we covered 20% only in the revision in this chapter. 20-25% only I covered, that to 45 minutes over revision itself. Next. This is risk of MMS is greater for non-routine transactions. Give some examples. This can be asked. Risk of MMS is greater for non-routine because greater management intervention, manual intervention, complex calculations. It is difficult for the entity to implement controls because of their non-routine. They are not regular transactions. So controls will not be there. For the special transactions, controls won't be there. Risk of MMS is greater for judgmental matters. Revenue recognition may be subject to different interpretations. Required judgment may be complex or subjective. Require assumptions about future events, going concern related things. These are all judgmental matters. So that's it. Risk assessment topic is completed. Technically speaking, risk assessment topic I have completed. Now I will discuss automated environment. So what is an automated environment? It is a business environment where processes like purchases, sales, accounting, payments, everything happens, operations, accounting, decisions, everything is carried out using systems. That's called an automated environment. Okay. So the concept of automated environment is to carry out business with less manual intervention. So the complexity of a business environment depends upon the complexity of automation. If the business is more automated, it's a complex, obviously. You need to understand so well the technology. What are the features? What are the key features of automated? They'll give a straight this question. What is an automated environment? What are the key features of automated environment? It enables faster business operation, accuracy in data, ability to process large volumes. Business operations can be integrated, accounting, payments, inventory, everything can be integrated. Better security and controls, less prone to human errors. Always you will have a latest information ready. Connectivity and networking capabilities. You can access data from anywhere. So you need to understand and document automated environment. Obviously, if a company is using automation, obviously today every company is using automation. Obviously they're using computers everywhere. So you need to understand and document what environment company is using. So the auditor has to document what information systems they are using. For example, a company is using SAP information system. They need to document their purpose. SEP is for accounting and supply chain purpose. You need to document like this. You need to understand location, where this SAP software is located. It's a cloud-based. Texas it is located, cloud server. What is the architecture? Which version the company is using? What interfaces they are using? Is it in-house? I mean customized, or it's a ready-made packaged? What activities company outsourced of the company? Some business processes. For example, a company may outsource payroll processes. Key persons for this entire automation is who? Chief Information Officer, Chief Information Security Officer, who? So the understanding can be documented like this. This has been asked 5 marks. I'll tell you one thing. From risk assessment, you'll get 5 marks question. From automated environment, you'll get 5 marks question. From internal control and IFC, these two put together 5 marks to 8 marks you'll be getting it. Materiality you'll be getting 3 to 5 marks question. And 330 you'll be getting 3 to 5 marks question. And 265, 450 you may be getting 3 marks to 4 marks question, or maybe 5 marks question. Any one question you might be getting. We don't know. Or maybe sometimes they'll ask, a question from each of this. We don't know. 3 marks. From every segment, you'll have a question. Now tell me, business automation environment, automation computers usage in business is so effective, so helpful. But there are some risks also. Like what? Unauthorized access to data. Somebody can hack the system and change the data. Direct data changes. Somebody will have, like CEO of a company will have super access, will have a privileged access. He can open and manipulate some accounting records. Segregation of duty may not be possible in automation environment sometimes. Unauthorized changes. Somebody can install some malwares and all. Failure to make necessary changes. Data may be lost. These are all the risks. Or processing will be wrong. Or processing the data wrongly. Getting it? Processing wrong data. Or right data only, but you are processing wrongly. Getting the point? Anything can happen. These are the risks. What is the risk? If at all there is a risk like this, no, in automated, what is the risk? It will impact on substantive procedure. Because if you find some risk like this, you will perform more in-depth procedures there. It will impact controls. You will decide control risk is very high, so it result into you will work more. It will impact reporting, especially if at all financial controls, if at all company internal financial controls which are automated, if at all the financial controls are not effective, under 143 subsection 3 clause I, we give modified opinion on IFC, impact on reporting. What are different types of controls in automated environment? The controls are broadly classified as general IT controls, application controls, IT dependent controls. Let's just best example. The phone will have a password, right? The phone will have a password, right? The phone will have a password, right? General password. This is a general IT control. And the phone, I'll be holding it carefully, getting it. So I'll be keeping it in my pocket, getting it so that nobody can take this phone. First of all, physical access control, physical access control, getting it. Now I'm recording this in my particular office cabin, getting it, the system. Nobody can enter into this cabin because there will be a security guard at the outside. These are all general IT controls. Generally, how your information technology systems physically or logically, how are you protecting? These are all called as general IT control. Sir, security guard is a general IT control. Yes, it's a general IT control because my system is being protected by the security guard indirectly so that nobody can come and access. That is general IT control. There will be, again, I have within the laptop, I have a, antivirus software, anti-hacking softwares and all. This is also a general IT control. And application control. Application control means, for example, you are watching this class on Shrestha application or maybe our website or maybe on a YouTube, getting it. Now that will have some controls again. That is called application controls. And there are a third category of controls that is called IT dependent controls. IT dependent controls. IT dependent controls are manual processes where we are using systems, where we are using technology, but we are manually processing the data. We are manually processing. Those controls are called as IT dependent controls. For example, whether the overall control environment, whether the overall systems, softwares and all properly implemented or not, who has to check? A human being has to check. That's an IT dependent control. Whether software is updated or not, I have to check. That's an IT dependent control. It's a manual element. So within automated environment, manual elements will be there. So general IT controls covers the following. What are the elements of general IT control? Data center network operation controls, program controls, access security controls, application system acquisition, installation, development and maintenance controls, General IT controls are implemented to mitigate specific IT risks across multiple systems and applications. They are pervasive controls. They are also called as indirect controls. Application controls it can be automated or manual at a business process level, purchase related controls, sales related controls. Getting it? IT dependent. They are basically manual controls, but we use system reports, all that. Getting it? So these controls are performed manually, and the effectiveness and reliability of automated controls, IT dependent controls require general IT controls. Only if general IT controls are effective, application controls, automated controls, IT dependent controls, everything will be effective. So general IT controls and application controls are interrelated, obviously. Now, how do you test automated environment? So how do you test in an automated environment whether controls are working effectively? I inquire first to people how the software is working, how the accounting software is functioning. Once again, I just try to enter some transaction and see whether the transaction is being accepted unauthorizedly. I will inspect the records. I will look at the system generated reports and all. I will observe what people are doing. There are 4 methods, right? One is inquiry, observation, inspection, reperformance. Getting it? Inquiry is most efficient method. We can quickly do it. Reperformance is least effective. It takes lots of time. But the evidence from reperformance is best evidence. That's why it's called most effective method. It's least efficient, but most effective because the evidence you get is super. Inquiry is very efficient, but the evidence is least effective. So generally what we do, inquiry in combination with inspection we do. What we inspect configuration, we do just to check a walkthrough test from what exactly happening, how purchases are recorded in the systems. So before recording in the accounting software, what are all steps there in the purchases? So walkthrough test I'll be doing. I'll check manuals, I'll check system logs, I'll do a negative testing. I'll try to enter some dummy transaction. If it is not accepting, then the system is working effectively. This is not required. 43. Data analytics, of course. So data analytics, of course, this is also an important question. Everything is important, by the way. So what is the data analytics? It is a process, tools, technique that is used to tap vast amount of data to obtain meaningful information. Suppose if I give you a sales report, if you give me a sales report, I will analyze the sales report in multiple ways. Which product is most selling? Which customer is most buying? In which month we are selling the most? In which quarter the sales are high? In which quarter, which product sales are high? You can analyze in multiple permutations and combinations a given data. You can analyze, so you can take a better business decision. Now, these tools and techniques are even used by auditor. Data analytic tool is used by auditor. The data analytic tools which are used by auditors are called as computer assisted audit techniques. So if any data analytical tools or data analytic tools which are used by auditor are called as CAT tools. Companies can benefit largely from use of data analytics for better customer service, all that. So auditor, especially data analytics auditor will use especially for checking completeness of data, for selecting samples, for recomputation of balances, mathematical calculations, analysis of journal entries as per SE 240. We don't have 240. For fraud investigation and all, we use data analytics. Digital audit is a very simple introduction. We have in CFNL a full-fledged chapter. Give a single reading. It's very easy only. Give a single reading. Then the most important, internal financial controls. What are internal financial controls? See, controls are nothing but some policies and procedures. Controls are nothing but some policies and procedures. Internal financial controls are for safeguarding the assets of the company. Companies, they maintain fixed asset register. Every time they purchase asset, they record it in the register. So if tomorrow they will check whether the asset is, what are all assets companies owning? How many the Infosys companies having how many computers? How do they know? How do the MD of the company know how many computers were there? He will look at the asset register. Then he will tell people, go and check whether all these assets were there or not. Safeguarding of assets. Prevention and detection of fraud. If any process, if any policy, if any control is implemented for prevention and detection of frauds, if any control is implemented for accuracy in accounting records, if any control is implemented for timely preparation of financial statement, if some process we developed, some system will develop for these objectives, for compliance with laws, some system will develop to achieve these objectives, and those systems, those processes are called as internal financial controls. Those systems and processes are called as internal financial control. Getting it? No. The IFC, internal financial control, is used even under Companies Act at many places. One of the best place that we know is 143 subsection 3. The auditor report shall state whether a company has proper internal, whether the company has adequate internal financial controls. Whether the company has adequate internal financial controls in place and are they operating effectively. The auditor has to specifically tell. This requirement is not applicable for 1% company. So if you're an auditor of 1% company, you need not talk about whether internal financial controls are operating effectively or not. You need not talk. For 1% company, or it's a private company where turnover is less than 50 crore, or borrowings from body corporates are less than 25. Getting it? This requirement shall not apply where turnover is less than 50 or borrowings from banks, FIs, or any body corp, nothing but borrowings are not exceeding 25 crore, turnover is not exceeding 50. If any one criteria also mismatch, like if turnover is more than 50, the auditor of that private limited company must give IFC report. Audit committee shall check internal financial controls, are they properly working or not. Getting it? Board of directors have to list out in director's responsibility statement, which is part of the board of directors report, whether they lead internal financial controls, whether their controls are operating effectively or not. Directors have to tell as per in the board report. They'll give you a question: what is internal financial controls? What are its objectives? Give few examples of internal financial controls reference under Companies Act. They'll give you this question. What is the relationship between IFC and IFC over financial reporting? Internal financial controls over financial reporting is required where auditors are required to express opinion. IFC refers to all the policies that have these objectives: prevention of fraud, reliability of financial reporting, getting compliance with laws and regulations, getting safeguarding of assets. These are all objectives of IFC. Not all these items impact financial reporting. Suppose accounting estimates, choosing an account, so disclosure related requirements, what are all disclosures should be made. So that responsibility company gave to one of the chartered accountant in the company who is in the accounts department. That's an IFC over financial reporting. That is a finance control, but related to financial reporting. Not every financial control is affecting financial reporting. We specifically have to talk whether financial controls related to financial reporting are operating effectively, especially we are concerned about IFC with reference to financial reporting. Therefore, IFC is a wider term, whereas financial reporting is a narrower term restricted to entities' internal control over financial reporting. So, internal financial controls over financial reporting are those controls which are only talking about preparation and presentation of financial statements. Documenting the risks is not required. We still have a 320 sampling. So, we still have 265 and 450. Almost 1 hour is done only for this. One more important question I'll show you. Explain methods of evaluation of internal control. How internal controls can be evaluated by auditor. Generally, in a company, processes will happen. So many processes. How auditor will evaluate them? Auditor can evaluate controls through 4 methods. One is narrative record. Generally, this is suitable for small entities where they will not have multiple people, multiple departments, multiple systems. That and all won't be there. So their controls are informally being performed. So their auditor will understand what control company is following, will try to develop a document, descriptive method. That's a narrative record. For some companies, we go and develop checklist. For some companies, we use questionnaire. Questionnaire is most popular. So where we will have a series of questions where we collect information about existence and operation of control. Getting it? So an important advantage, in questionnaire, the answer is generally given. We develop the questions, client will answer. So the answers are given as yes, no, not applicable generally. Yes means effective, the control is working fine. No means the control is not effective. In such a way, we design questions. So examples of internal control questionnaire, these examples are very important. Items of financial statements, only after watching this, you can understand this better. So they'll give you what is an internal control questionnaire, meaning they'll give an example of draft an internal control questionnaire for purchases, or draft an internal control questionnaire for creditors, draft an internal control questionnaire for inventories. They'll ask you anyway. That's it. That's it. With this, I will put full stop to risk assessment chapter. I will now discuss further 265, 450 and materiality. This I will be discussing little in depth. So 265, 450 and materiality. That's it. So continue watching. First I'll be covering 265, then 450, then materiality. That's it. With that, this part 4 will be completed. Of course, in this part 4 itself, audit of balance sheet items and items of financials is included. And we also have included SQC 220 also. I hope you have watched it. Look at the time step if at all you didn't watch. So let's continue 265 standard. Communicating deficiencies in internal control to those charged with governance and management. See, in risk assessment and internal control, first we evaluate risk, then we check internal controls. In the process of audit, when we are doing audit, we will discover so many material misstatements. And we will also be discovering so many processes, so many controls which are not functioning effectively. Or we also discover sometimes some processes, some business process where there is no control at all. Company has not implemented controls at some risks. There is a risk, but there is no control, corresponding control. So if a control which is already designed, implemented, operated, but unable to prevent, means control is existing but not effective. That is a deficiency in internal control. And a control that is necessary to prevent, necessary to detect, necessary to correct, a control should be there, but is missing. Both are deficiencies. It can be asked as an MCQ. What is a deficiency in internal control? See, the standard is what they're saying, communicating deficiencies in internal control to those charged with governance and management. If you find any deficiencies in controls, communicate it to the management, communicate it to the top management. Control deficiency means what? Generally what people think, if control is not working effectively, then we have to communicate. Not just that, if a control is missing also, suppose there should be a control at some purchases. For some purchases or for some warehouse, some CCTV cameras is not there. For example, you should tell the company, you must have CCTV cameras in godown. Control is missing, right? That is also a deficiency. And this standard classifies deficiencies into two types: significant deficiency, other deficiency. Significant deficiency, you must communicate to those charged with governance. Significant deficiency means very big deficiency. Other deficiency, you can communicate to concerned management person itself. Means the purchase manager, production manager, accounts manager, their level. Suppose if you think this something control, some problem in the control, this is something top management must know, then TCWG. So what is a significant deficiency? It's a single deficiency or a combination of multiple deficiencies. Getting it? Is of so important to merit the attention of top management. Significant deficiency depends not only whether misstatement really occurred. See, sometimes what some people argue, hey, there is no mistake. No, how come you say control is not working properly? How come you said it's a deficiency? Whether mistake happened or not is not the issue. Mistake possibility is there, na? So also likelihood of that misstatement, significant deficiency is not only about actual mistake which has already occurred. No, just because a significant deficiency in internal control depends not only on whether misstatement actually occurred, but likelihood that material misstatement or potential magnitude. What is the likelihood of material misstatement, or what is the potential magnitude of the material misstatement? What is the potential magnitude of the misstatement? That decides whether deficiency. So control, if it is not there, it leads to so much big mistake. Today no fraud happened, but tomorrow fraud can happen. Na? Significant deficiencies therefore exist. Even though auditor has not identified a material misstatement, they'll give you a twist, a correct or incorrect statement in MCQ format. They'll give you, since there is no misstatement, the accountant of the company argued that this is not a deficiency. Wrong. Getting it? So now tell me, what matters? You auditor will consider whether a deficiency or a combination of deficiency constitutes a significant. You found some weakness in control, some control is missing, some control is not working. How do you know that's a significant deficiency, normal deficiency? How do you consider? I will check likelihood of deficiency leading to misstatements in the financial statements. If at all that mistake, if at all that control weakness is going directly affecting financial statements to be materially misstated, that's a significant deficiency. If there is a possibility of fraud, it's a significant deficiency. Subjectivity and complexity involved, so complex, so high judgments are involved, it's a significant deficiency. The financial statements amounts exposed, how much amount is exposed from the financial statements because of this mistake, how much amount can affect, that's a significant deficiency. How much volume, how much business is happening in that particular area. If it is so volume, it's a significant deficiency. Now tell me whether a particular control is important for financial reporting process. How important is control to financial reporting process? If this control is not working properly, financial reporting will affect. Some internal financial control related to financial reporting is not working effectively. That is also significant deficiency. How do you check whether a particular control is relevant for financial reporting? This itself can be asked as a 4 marks question. Importance of controls to financial reporting process is one of the factors for determining significant deficiency in internal control. What are the factors? 4 marks, they'll ask you 4 factors. Are there controls over frauds, prevention and detection? Are there controls over selection and application of accounting policies? Are there controls over significant transactions with related parties? Are there controls over significant transactions outside the entity normal course of business? Are there controls over period and financial reporting process? General monitoring controls, if at all the controls are weak, it's a significant risk. We have seen significant risk also similar points. Risk of prevention and detection of fraud, the selection and application of accounting policy, transaction with related party, outside normal course of business, non-routine transactions and all. We have seen in significant risk discussion. Then, will there be indicators of significant deficiency in internal control? Like, will there be any symptoms? Like, okay, fine, I understand. So, will there be any symptoms? Like, what if exist? There will be a possibility of significant deficiency. What if? Is there any symptoms or indicators? Yes, some management fraud you identify, top management fraud you identify, or management, no, they fail to implement remedial action on deficiency. Last year also I'm the auditor, I communicated these weaknesses were there, but still management did not rectify. It's a symptom that management intentionally doing the risk of fraud. Absence of risk assessment process within the entity primarily responsible to do risk assessment process, they're not doing. Or ineffective risk assessment process, companies doing risk assessment process, but that is ineffective, just for namesake they're doing. Ineffective response to identified significant risk. Some significant risk is identified, but companies not responding properly. Internal auditors are saying companies not answering them properly. Or misstatements identified by you, that indicates some control is not functioning properly. Disclosure of misstatements in prior period items, that is also a risk, a significant risk. Management is inability to oversee. Management is not properly looking at financial reporting process. Top management is not involving properly. That's a significant risk. Now what you have to do? Ultimately, on the basis of work performed, you have to check whether any deficiencies, one or more deficiencies, whether they constitute significant deficiency, you need to decide. So once you decide, communicate to top management. What you have to communicate? You have to communicate on a timely basis. Don't communicate at the year-end audit. Communicate as and when you find a significant deficiency. So the auditor shall communicate to management at appropriate level of responsibility on a timely basis in writing significant deficiencies in internal control. The auditor has to communicate to those charged with governance unless it is inappropriate. Unless it is not relevant for them, don't communicate. If you think top management should see this, communicate. Suppose if you find some other deficiencies which are not significant, other deficiencies internal control identified during the audit that have not been communicated to management already, you have not yet communicated, communicate it to management. That's enough. The auditor shall include in written communication. So when you are communicating deficiency, you must communicate in writing description of deficiency and the explanation of their effect. When you are communicating, don't say that purchase control is not proper, purchase order control is not proper, GRN control is not proper. Also say what if it is not proper, what can go wrong. You should also take potential effect. What is the effect of it? This is also very important. Only communicating this is not important. Only communicating this control is not working is not enough. You should also tell what is the consequences if this control is not working. Sufficient information also add. When you are communicating, add sufficient information so that top management and management understand what exactly you are communicating. In particular, the purpose of the audit. By the way, when you are communicating, management may say, sir, only these deficiencies, sir. Why don't you find all the deficiencies? You need to tell you, sir, my objective is to do audit. During the audit, if I find any deficiencies, that only I will communicate. I am not here to communicate 100% problems in internal control. So, also mentioned the purpose of audit is to express opinion. Audit includes consideration of internal controls, that are relevant for financial statements, but not for the purpose of giving opinion on the complete controls. Our audit is not to do, we are doing audit not because of giving opinion, not for the purpose of giving opinion. So whatever matters which we are reporting are limited to only those deficiencies which we identified. So whatever deficiencies we communicated, that we only identified this. They are not exhaustive. Getting it? That's it. So here there is a practical question. 265 is actually quite easy. Just that you need to understand the gist of the standard. You need to understand the entire standard as a whole. So the objective of the auditor is communicate properly to top management and other management deficiencies internal control which auditor has identified during the year. Whatever you identified that in auditor's judgment are of sufficient importance to merit top management or management attention. So with this 265 standard is over. So simple actually. You read this now with this understanding, you will get it very easily.
Yes, let's proceed with SA 320. Materiality in planning and performance of an audit. Actually, the institute book says refer CA intermaterial for this. So just I'm covering because many do not understand this standard, though they think they understood. Okay. Now, first of all, there are some terms that you need to understand, which I briefly give you an idea. There is something called overall materiality, performance materiality, triviality level materiality. Materiality, triviality levels, we call it as trivial. Okay. Suppose the company has the auditor has determined in the circumstances, based upon the given circumstances, where auditor felt for this company, turnover is the right benchmark. Auditor felt turnover is the right benchmark. For some entities, turnover may not be the benchmark. For some entities, capital invested is benchmark. For some entities, profit is the benchmark. For some entities, something else could be the benchmark. Getting it? Suppose if the auditor felt in the company where he is doing audit, turnover is the benchmark. He applied 0.5% as some amount. That is the overall materiality level. Let us assume turnover is 100 crore or else 10,000 crore. 1% means 100. 50 crore could be the materiality, overall materiality for the financial statement. So what do you mean by this overall materiality for financials? If at all, the aggregate of the misstatements that you identified, if at all it is exceeding this, you assume that financial statements are materially misstated. But 50 crore aggregate of the mistakes I identified means what? Within the sample I selected, these are the mistakes I identified. What about undetected mistakes? See, I do audit on a sample basis. Within the sample only I'll identify mistakes, right? Within the sampling only I'll identify mistakes, right? So within the sample, the total of mistakes are crossing materiality level, overall materiality level for the financials. Okay, I agree it's a material misstatement, but I have not verified 90% of the population. What about the mistakes that are there in the 90% of population? So let me not compare my aggregate of misstatements with the overall materiality level. Let me decide my materiality level 30 crore. Overall materiality 50 crore. Let me fix my performance materiality at 30 crore. While performing the audit, materiality ultimate is 50 only. But I will not compare with the 50 every time. I will first compare with the 30. Now, whatever mistakes I am identifying, if at all the moment it crossed 30, definitely total misstatements in the entire population will cross more than 50. No doubt about it. If at all within the sample I have selected, based on the sample, the mistakes I identified, if at all the sample related mistakes, which are called as uncorrected misstatements, they themselves are exceeding 30 crore. What about undetected misstatements? Both put together will be definitely more than overall materiality. If at all the uncorrected misstatements cross performance materiality, I will stop doing audit. I will take more samples. I will once again do audit procedures on those samples also. Once again, I will re-evaluate. Are you getting it? Now, here, there is something called PMS, projection of misstatements. What is it? Projection of misstatement.
TMS, tolerable misstatement, projected misstatement, tolerable misstatement, risk of material misstatement. Getting it? You need to understand sampling chapter for this. Okay. They'll give you a question on sampling like this. It is there in CA final RTP or MTP somewhere I've seen. Which of the following is not a factor for determining sample size for test of controls? Sorry, test of details. Which of the following is not a sample size for test of details? 1. Risk of material misstatement. 2. Expected material misstatement. 3. Projected material misstatement. 4. Tolerable material misstatement. Sorry. Tolerable misstatement, projected misstatement, expected misstatement, risk of material misstatement. The answer is projected. The answer is projected. You should not guess without understanding the 4. That should be the correct answer. If I ask you what is the right answer, you should say something. You should not say something. You should say don't know. Getting it? So, projected misstatement. See, first of all, in sampling, what is the objective? Objective of audit sampling. Based on samples, you draw conclusion on population. So, no, purchases are 10,000 crore. But you verified sample whose value totally comes to 500 crore. Getting the point? Only 500 crore worth of transactions only you verified in sampling. The total purchases are how many? 10,000 crore. Suppose within 500 crores worth of purchases, you found 2 crore worth of misstatement. Now, within 10,000 crore, how much? This activity is called as projection. Projected misstatement is nothing but uncorrected misstatement plus undetected misstatement. Uncorrected means what? 2 crore worth of mistake I found. Yes or no? Within 500, 2 crore. Within 10,000 crore, some 20 crore. Let us assume, example sake. Getting it? Out of this uncorrected 2 crore. Undetected by me, 18 crore. 18 crore mistake is not detected. I just projected it based on this sample. But remember, before you do this projection, you should interpret the nature of the misstatement. 2 crore misstatement you found, right? What is the nature? Is it an anomaly or is it a non-anomaly? SA 530 says you should only do non-anomalous projection. You should not do project anomaly. While projecting the misstatement, anomaly should be excluded. What is an anomaly? A misstatement or deviation that is demonstrably not representative of population. You didn't understand? Okay. So, see, that's why you have to be very good at CA inter audit fundamentals. Be qualified without learning, that's a different story. Okay. Anomaly means what? Not every mistake. Suppose 2 crore mistake is there. I will interpret what is this mistake is of. This mistake, no, the accountant very basic example I'll take. Okay, lame example. Suppose accountant, no, while passing 10 lakhs entry, he passed 1 crore. While typing, no, let's assume they are not capturing the transactions automatically, they are manually entering the transaction. By mistake, instead of 10 lakhs, he entered 1 crore. Or else by mistake, instead of 20 lakhs, he entered 2 crore. Let us assume round of mistake is 2 crore 20 lakhs he entered. Getting it? The misstatement is how much? 2 crore. That is the nature of the mistake. Now tell me, if this is a mistake, can I project it? In 500 crore, 2 crore he typed wrongly. In 10,000 crore, how much he typed wrongly? This is called anomaly, which is not representative of population. Nothing but non-repetitive misstatements. These mistakes are non-repetitive in nature. Whereas non-anomaly, in the software only, when you enter 5 zeros, it will automatically 6 0. Now tell me, wherever 5 zeros are there, 6 0 automatically adds. That's a repetitive mistake. Are you getting the point? If there is a mistake in the software, if there is a mistake in the formula of depreciation computation, interest computation, that's a non-anomaly. Suppose the interest computation in a bank went wrong, where bank, instead of the number of days divided by 365, it should be the last item in the formula of the interest computation. This itself is not there. They directly applied rate. Now tell me, in every interest calculation, mistake will be there, right? There I can project. What is the total mistake? I can project it. Remember, projected misstatement on the total population is what we evaluate for considering overall misstatement. Are you getting the point? So what is what is overall misstatement? Overall misstatement is equal to nothing but is also called as total misstatement is equal to projected misstatement plus anomalous misstatement. Anomaly you don't consider in projection. Are you getting the point? So what is the total projected misstatement plus anomalous misstatement is equal to total misstatement. If this total misstatement is crossing performance materiality, you will conclude that you have not obtained sufficient appropriate evidence. You will conclude the moment it crosses performance materiality, you have the standard indirectly says, do take more samples, take more samples. You take as many samples as possible where total misstatement comes less than performance materiality. You should do repetitively the task until you get less than performance materiality, total misstatement value. You got that's acceptable level in audit. Then you give opinion. Suppose in spite of repeatedly you are selecting samples additionally, projecting, overall material misstatement is always crossing performance. You will come to a conclusion that the financial statements are substantially misstated. You will give adverse opinion. This is what happens in Big Four. So they use all this terminology in Big Four. Exactly. Getting it? So they in the documentation, everything, triviality level, everything. Now, so this is how the materiality concept works. First of all, got clarity on this? Basic understanding how materiality 530, everything is interrelated. In 530, so now tell me. So projected misstatement is what, like the MCQ which I told, no. Which of the following is not a factor for determining sample size in case of test of details? So purchases I want to verify. How many samples I should verify? For that, what should be the factor? Projected misstatement is not a factor. Why? After selecting sample, after verified, after finding mistake, after determining anomaly, non-anomaly, then I will project the final misstatement. Projected misstatement is a result of the entire sampling process. That is not a basis for selecting the sample. So only if you know projected misstatement meaning, you will come to an understanding like this. Tolerable misstatement is called as performance materiality. In 530, it is called as tolerable misstatement. In SA 320, it is called as performance materiality. If total misstatement is less than performance materiality, it is tolerable, right? We can give unqualified opinion, right? That's why it's called as what? Tolerable misstatement. So tolerable misstatement is nothing but performance materiality. This is the understanding you must have when you are reading 530 and 320. This link you should understand. Okay. What is the concept of materiality? Remember, materiality is not always a matter of size. It may be a matter of quality. Getting it? Quantitative limits of materiality generally we will specify. For example, a company disclosing notes, additional information, any income or expenditure exceeding 1% of the revenue or 1 lakh, whichever is higher. So financial reporting framework itself gives a hint. Anything which is more than 1% is an important item. A company should disclose in notes to accounts shares held by shareholders more than 5%. Suppose in share capital, if you want to decide apply materiality, you can take that schedule 3 5% logic itself. Suppose what is materiality? If financial reporting framework do not contain any reference, if the financial reporting framework schedule 3 or accounting standard, if at all they are not talking about any percentages and all, how do you decide materiality? Misstatements are material generally if at all they influence the decisions of the user. You should think if there is a mistake in the profit and loss account 10 crore, will the user affect? If the mistake in profit and loss account is 50 crore, will the user affect? No. If the mistake in the P&L is more than 100 crore, will the user affect? Yes. Then 100 crore is a materiality. Getting it? Judgments about matters that are material are based on consideration of common financial information needs of users. The possible effect of misstatement on a specific user may vary widely and is not considered. For a particular user, some users are so aggressive. Sir, 500 crore mistake also I'm not bothered. That and all you should not take into account. Commonly, major users, what amount they feel material, so that their decision they will change. Okay. Now, ultimately remember, determination of materiality is a matter of professional judgment. The auditor's determination of materiality is a matter of professional judgment and is affected by auditor's perception of financial information needs of the users. Having a reasonable knowledge of business and economic activities and a willingness to study the information in financial statement with reasonable diligence. By the way,
In this context, it is reasonable for the auditor to assume that users have the knowledge. When you are taking assumptions regarding materiality, you take the following assumptions. Users know, they understand financial statements, they will read the financial statements. Taking those assumptions, you decide materiality. Don't think that users and all will not understand any materiality, all that, which is reality. Okay. Understand that financial statements are prepared and presented and audited to levels of materiality. We always should consider materiality when we are doing audit. Recognize uncertainties inherent in the measurement of amounts based on estimates, judgments, considerations, and future events. Many accounting estimates will be used by the management. For sure, they may not turn into reality. There will be uncertainty. Keep that in mind when you are fixing materiality. Make reasonable economic decisions on the basis of information in financials. Users should be able to make reasonable economic decisions. So, in order to take a reasonable economic decisions, what amounts they consider, how much amount if there is a mistake, their decision making process will influence. You should check. Generally, this much effort and all is not required because mostly applicable frameworks itself gave 0.5% of turnover, 1% of turnover, schedule 3 and all they gave clearly. Yes or no? In part 2 something 0.5%, in part 1 I think 1%, some value depends. Getting it? So schedule 3 itself gave what is materiality, that itself you can happily consider. Clear? These are all generally they have discussed. So much of general content is there. Performance materiality, this will check. What is the performance materiality? Performance materiality means the amount set by auditor at less than materiality for financials as a whole. I told you 50 crore is overall materiality, 30 crore. To reduce to an appropriately low level the probability that aggregate of uncorrected and undetected misstatements exceed materiality for the financials as a whole. So, in order to reduce, see that's why we will keep a gap of 20 crore. We will keep a gap of how much? 20 crore. If the gap between overall materiality and performance materiality is very high, you are expecting high risk there. If the gap between overall materiality and performance materiality is very low, the gap is very low, which means your risk assessment gave a satisfaction that risk is less. So when you expect risk is less in the financial statements audit, you generally keep performance materiality as close as possible to overall. If you think risk is very high, performance materiality, you will keep very huge gap from overall materiality. Actually, there is a Shell audit report. In that Shell audit report, UK, so they clearly presented workings on materiality. So why they choose an performance materiality at so and so level, why they have chosen overall materiality at so and so level, they have given entire the background information also. Shell, you know Shell Petroleum, yeah. So Shell, so that company UK, in that annual report, the auditor's report is very detailed, not like ours. Of course, ours is good, but that is much more detailed. How auditor decided materiality, he gave 1 page discussion. How overall materiality, last year overall materiality this much, this year this much, last year performance material this much, this year this much, what is triviality level, they clearly mentioned. Getting it? And they clearly mentioned why there is a change in the materiality, revision in the materiality. So they clearly mentioned all that. I think that if you see also, you will get much more understanding. Sometimes performance materiality also refers to amount set by auditor less than materiality level for a particular class of transaction. Sometimes if you want, you can keep performance materiality for each class of transaction separately. This is what in reality happens. Overall materiality same for everything. For purchases, what is performance materiality? For sales, what is performance materiality? For inventory, what is performance materiality? We can keep like that also. So they'll give you a question on this. What is performance materiality? That's it. They'll give you, probably this itself. What is performance materiality? And while determining materiality, auditor will use benchmarks. Some benchmarks we will use. One is elements of financial statements like turnover, capital, expenditure, all that. And you will consider nature of the entity and its life cycle, industry and economic environment. You may consider ownership structure. You may consider volatility of the benchmark. Suppose if you think turnover is so extremely variation, there is extreme variation in the turnover from last year, and this year. Turnover may not be a right benchmark. You choose some other benchmark which is less volatile. Based on that, apply percentage and choose materiality level. In November 22 paper, I think so, they have asked a question on this. Which is right benchmark? I think in the pronouncement book, actually in the main book you will find this. Main book I have given the content with that example. That question only they asked in CA final, November 22 paper, I think so. So there they will give you some sales data they gave you and some profit before tax, some information they gave you, which is the right benchmark. And they gave you some symptoms that company profit is last year it has lost, this year they have a profit. So company have chosen, the auditors have chosen materiality based on profit before tax. You need to answer profit before tax is highly volatile. So this is not a right benchmark. The right benchmark for the company sales are constant. Sales is a right benchmark. This answer we should reply by writing the factors affecting the benchmark. So what are the factors that affect in identification of appropriate benchmark? Getting it? This question only they asked. 4 marks question they asked. 4 marks or 2 marks, some 2 sub questions were given. In that one sub question is this. Number 22 paper, I think so. I'm strong. I think I'm very sure. Number 22 paper only. Just check out. Number 22. Every time auditing paper comes, people say that's the toughest paper. Now, these benchmarks like turnover, capital, profit before tax, from where you can take? You can take them in current period financials. You can take from the current period financials, period to date financial results. Or you can take from prior period statements. Or you can take benchmarks from budgets and forecasts. Whatever you feel most appropriate, that benchmark you select, based on that apply a percentage, you will get materiality amount. You decide that with the total misstatement. Total misstatement means projected misstatement plus anomalous misstatement. Projected misstatements means what I told. This is a link. Only those who understood 530 thoroughly can understand 320. Because in 320 they use entire the terminology used in 530 sampling chapter. And once you fix a benchmark, apply a percentage on it. Generally, on profit before tax, we apply higher percentage. If it is turnover benchmark, we apply lower percentage. Getting it? 5% of profit and 0.5% of turnover, both are not same. So if profit before tax is the benchmark, how to decide materiality amount? Apply a higher percentage in comparison with the turnover benchmark. So there is a relationship between percentage and chosen benchmark such that percentage applied to PBT from operations will normally be higher than a percentage applied to total revenue. Okay, these are all may be relevant for MCQs. That's not required. Materiality for class of transaction. Revision of materiality, important question for 4 marks. Revision in materiality. Will auditor revise the materiality? So of course, as audit progresses, if you got to know some additional information, a change in circumstance, availability of additional information, change in actual financial results than anticipated results. I'm continuously finding so many mistakes. I may have to decide materiality at lower. Generally, you might have seen this word, audit risk and materiality are inversely related. If you predict high risk, you keep materiality at low level. You will verify even small transactions. Getting it? Increase in estimated risk than the original prediction. Originally, you predicted low risk, so you kept a 50 crore materiality. Later, you felt that risk is very high. You can reduce it to 20 crore. In Shell, they will give all this data. Better I'll open once, okay? So you will get an idea. Just this alone we'll discuss and close, okay? Actually, the standard takes lot of time. I just want to introduce you what is there in the standard. If at all you have time, only study, but don't neglect, because even in the old scheme 320 discussion is not there, but they asked a question. So now also 320 discussion is not there in the final material, but they'll ask a question. Possibility is there. 2022. For them, the balance sheet date is December. They follow calendar year. So that's the balance sheet date. Let me check once, is it there in my data or not? Amma, it is there. See, this is auditor's report, independent auditors reports to members of Shell Public Limited Corporation, opinion paragraph, basis for opinion, conclusions related to going concern. It's not uncertainty and all, just the conclusions on going concern. Overview for audit approach. In that, assessing materiality, planning materiality. This is also called as overall materiality, nothing but 1.2 billion. In 2021, 1 billion. And performance materiality, 0.9 billion. In 2021, 0.75. Reporting differences, nothing but triviality materially. So now when my team is working, audit team, if they find a mistake more than this much value only, they have to report it. Otherwise, they can ignore that mistakes. But they'll just keep aside all the mistakes which are less than this. They will not immediately react. Getting it? Now, they have made probably here, they might have given some, we based our materiality on normalized adjusted earnings on a pre-tax basis. So that's a benchmark. Pre-tax normalized earnings. This approach removes both effects. So they're giving reasons. We concluded that it's appropriate to set planning materiality at 1.2. We adopted the following materiality measures in 2022. I think 21 report has much more detail. In 21, no, they changed it. These are latest numbers, 22. In 21 Shell report, no, these numbers are different. At the time, they clearly mentioned because of COVID pandemic, all that, the risk has been increased a lot. So materiality, overall materiality, they changed it drastically. Performance material also, they changed it drastically. You see here, overall materiality 1.2 billion. Performance materiality 0.9, just a 25% variation only. Whereas in the 2021, overall materiality 1 billion, performance materiality 0.5 billion. The gap was very high because at that time, since because of COVID, fraud risk factors are very high, pressures are high. So they mentioned that reason. Now again, they revised it to 0.9 billion, which is nearer to planning materiality. Clear? Now you see, so auditor has to revise material. Under what circumstances auditor will revise the material? This can be one question. Remember, benchmarks related is very important because they will give you some benchmarks. Which benchmark you will choose for deciding materiality? They'll give you characteristics of each benchmark and company, that which is volatile, which is not volatile. Generally, we take that benchmark which is standard, which is not that volatile. Getting it? And documentation of materiality. What is the materiality for financials as a whole? That is called as actually planning materiality. In our standard on audit 320, we call it as overall materiality. In international standard auditing, they call it as planning. In fact, this is heading of the standard. Materiality in planning and performance of audit. Same names they use. Planning materiality, performance materiality. Materiality levels for particular transaction. Have you set any specific performance materiality levels? That one. General performance materiality document. Revision of the materiality document. They may give you a straight question on documentation of materiality. Clear? I know I have not given depth information like other standards, but I'm telling you, if I go in depth, it will take lots of time because this is linked with others. I just want to bring you out that fact. Okay, that's it. So just look at November 22 paper or May 23 paper. This question is there. Just go through it once. If that in both it is not there, May 22 it would be. Okay, for sure in these three only, I'm sure. So there is a question on benchmarks. They specifically tested on that. Okay, and only those who understood this discussion right now, whatever I said thoroughly, can answer that question. Very practical question. Clear all of you? Yeah, bye.
Let's continue the revision of SA 450. Evaluation of misstatements identified during the audit. This standard anyone can understand only if they understand 320 and 530. If at all you don't understand 320 and 530, it is impossible for anybody to understand this standard perfectly. Because the standard is very small, simple, but complicated. This talks about, if you don't understand these two standards, many points in the standard, you will not understand why you're reading. Getting it? Fine. So this standard, if you look at, it has 4 parts actually. One talks about object, one question. Another question talks about when you're doing audit, whatever mistakes that you are identifying when you're doing audit. Generally, when we identify material misstatements, how do we identify misstatements in audit? When we are performing further audit procedure, substantive analytical procedure, test of details. Getting it? When we are performing these substantive procedures, we obviously identify misstatements. And those misstatements we should accumulate. Accumulation will happen of only those misstatements which are not clearly trivial. What do you mean by not trivial? That's why you need to watch 320 revision first and then come to 450. In 320, I clearly told materiality is at 3 levels: triviality level, performance materiality, overall materiality. Any material, any misstatements that is less than trivial, we generally ignore. More than trivial, we accumulate. If those accumulated triviality level misstatements beyond triviality level, those accumulated misstatements, if at all they are crossing performance materiality, then actual misstatement in the population is higher than the material, the mistakes that you identify, the possibility, because the mistakes that we identify are only based on sample. The mistakes, whatever we identify, we call them as uncorrected misstatements at first. So first, what we should do when we identify misstatements, first we accumulate misstatements which are all above triviality level, which are less than trivial or trivial, we ignore. But above triviality level, we accumulate all the mistakes. We communicate management for correction. We request management. We always ask management. We don't directly, suppose if there is a material misstatement, we don't try to give disclaimer of opinion we don't try to give adverse opinion or qualified opinion. First we communicate management, sir, these are the mistakes that we identified. Remember, whenever you are identifying misstatements, you must communicate on a timely basis as and when you identify. And ask the company, ask the management, ask those charged with the governance to correct it. If management is not correcting, evaluate uncorrected misstatements. What is the impact of the uncorrected misstatements on the financial statements as a whole? Evaluate. If you think the impact of uncorrected misstatements on the financial statements is material but not pervasive, then you will give qualified opinion. Again, here also you will not straight away give opinion. First you prepare a draft audit report as per 705. The draft audit report you will first give it to the management and those charged with governance. Then if still management do not respond, then you will finalize that audit report and give qualified opinion. And whatever misstatements that you identified, documented. Whatever misstatements you communicated to the management, documented. Whatever misstatements that were corrected, documented. And there will be some mistakes which you identified in the sample itself. In the sample verification that you did, in that itself you would have identified some mistakes which are not corrected, which are not rectified. Why management has not rectified? They are saying, sir, these mistakes and all are not material, sir. So it doesn't require correction unnecessarily. Why? Already financials and all approved, sir. Books of accounts are closed already. You don't want to correct. These are all immaterial mistakes. You are also convinced, okay, these mistakes all put together. I also convinced after discussing with the management. I also considered, they are beyond triviality level, but less than performance materiality, less than overall materiality, less than tolerable misstatement. Performance materiality is the word which is used in 320. We have a materiality standard in PCAOB framework in United States where it is called as tolerable level. Tolerable material, tolerable misstatement. Tolerable misstatement itself is called as performance materiality. I covered this in 320 already. So some mistakes, management did not correct, saying they are all, sir, aggregate and all not material. Okay, I was also convinced they are not material. Get a declaration. Get a representation under 580 that the aggregate of uncorrected misstatements. Uncorrected means what? Which I identified already. I detected them. But not yet corrected. Uncorrected misstatements aggregate is immaterial. Management believes that they are immaterial. Get a written representation and document. Are you getting the point? This is what the entire standard exactly says. So let's look into the standard very briefly. So before you form an opinion, you must evaluate whatever mistakes you identified which are not yet corrected in the financial statements. What is its impact? Getting it? So the standard deals with auditor has to evaluate what is the effect of identified misstatements. You identified mistakes, what is its effect? Generally, when you identify mistakes, no, you will revise. When you identify mistakes within the sample itself, no, you will revise audit plan, audit strategy, because you will increase your sample size, all that. And whatever mistakes you identified, you will communicate to the management. Once you communicate, they will either correct it or they may not correct it, uncorrected. Now, what is the impact of uncorrected misstatements on the financials? This will lead to, see, generally, first we identify mistakes. And what is the mistakes that you identified on the audit? On audit, no, it will affect my nature, timing, and extent of further audit procedures. It will affect my audit plan. It will affect my audit strategy. Definitely, it will affect my materiality level. These are all effect on the audit. Okay, fine. All that is fine. You somehow continued the audit. You finally communicated the mistakes to the management. Some of them they corrected. Some of them they have not corrected ultimately. At the end of the financials also, at the end of the audit also, there were some mistakes which are not corrected. What is its impact on the financials? That also we need to consider. If at all the effect of uncorrected misstatements on the financials is material but not pervasive, getting it, qualified opinion, material and pervasive, adverse. Suppose if the effect of uncorrected misstatements is not material, mistakes were there, some are corrected, some are not corrected, whatever they were not corrected, right? If they are immaterial, get a written representation as per 580 that management and those charged with governance believes that the effect of aggregate of uncorrected misstatements that are communicated to the management by auditor are immaterial. That is what the requirement of the standard. Now look at it. So when the auditor is doing audit, when auditor is doing the audit, the auditor shall accumulate misstatements which are identified other than those that are clearly trivial, which are trivial level, which are trivial or less than trivial. Ignore them. If at all you are finding mistakes which are triviality above triviality level of the materiality, accumulated. Don't qualify, first accumulated. If at all those accumulated misstatement exceeds performance materiality, there the risk comes. There the risk comes. If it exceeds performance, nothing but tolerable misstatement. In 530 also, evaluation of sampling results. There is a statement. If projected misstatement and anomalous misstatement, nothing but if the total material misstatement, including projected, if at all approaching tolerable material, if at all exceeding tolerable materiality misstatement, then actual misstatement in the population could be very much higher. The sample would have been not given appropriate. So what indirectly standards is saying, whenever accumulated misstatements are crossing or reaching performance, increase the sample size and once again do test, once again project. Be able to understand. So now a misstatement, why a misstatement arises? It may be because of omission of an amount or disclosure, or some capitalization happened for a revenue expenditure, or vice versa, or some inaccuracy while entering the transactions into the books of accounts and into the financial statements. So what auditor has to do? What auditor has to consider when he identifies misstatement? Auditor shall check whether there is a revision for overall audit strategy, overall audit plan to be revised. Whether overall audit strategy and plan has to be revised. You see, audit strategy chapter, what are the factors auditor shall take into account while developing overall audit strategy? What factors auditor shall take into account while developing overall audit plan? Materiality. Effect of identified misstatements. So if you identify mistakes, you may have to again modify the plan, because within 100 samples out of 10,000 population, these many mistakes you found. How many were there in the population? You can't directly project it. So take another 100 samples. See whether you can identify more mistakes in that. So the auditor may determine the audit strategy plan to be revised if nature of misstatements could be material or aggregate of misstatements approaches performance materiality. If aggregate of misstatements approaches materiality, if accumulated misstatements approaches materiality, approaches performance materiality, crosses performance materiality, revise your audit procedure, increase the sample size. In that case, auditor may ask management, dear management, only within the sample itself, these many mistakes were there. It is crossing already materiality. There is a possibility that entire purchase transaction will have so many mistakes. Please do identify, understand the cause of mistakes. Please ask them to determine amount of actual misstatement in the entire purchases, class of transaction. Getting it? And once auditor requested, management, they will verify entire purchases once again in depth. They'll do internal audit, they'll do in-depth audit. Getting it? Auditor shall check whether is there any other mistakes remained or identified by the management. Next. Once, okay, fine. So once mistakes are identified, I will plan my audit process. I will change my audit procedures. I will change my audit plan. I will increase sample size. I will also ask management to do in-depth audit, all that. Once everything is over, once mistakes all are identified, uncorrected mistakes all are identified, I will have to communicate on a timely manner. And if management is correcting the material misstatements, I will check whether they corrected properly or not. Getting it? If at all management refuses to correct, understand why management is not correcting, and once again check whether as a whole the financials are material free from material misstatements. And look at management ultimately said some mistakes they didn't correct. No, what is its impact? What is the effect of uncorrected misstatements? Suppose, look at, the auditor shall determine whether uncorrected misstatements are material. While deciding whether they are material, look at the size of the mistake, nature of the mistake. Getting in, nature of the misstatements, nature of the misstatements, is it repetitive or non-repetitive or anomaly? What is the effect of uncorrected misstatements related to prior period, if at all? If at all any mistakes are related to prior period, what is its effect? Communicate. The auditor shall communicate with top management regarding uncorrected misstatements and what is its effect on the opinion. So ultimately, whatever mistakes still were left, not at all rectified in the financials, the mistakes are as it is kept. What is its impact on audit opinion? Check. The auditor auditor's communication shall identify material uncorrected misstatements and request them to be corrected. The auditor shall communicate with the top management misstatements related to prior period also. If at all any mistakes you identified which are material related to prior period, communicate to top management. And ultimately, management is not correcting some mistakes. Some mistakes, no, as it is like that, it is there. Some mistakes, ultimately, they are not correcting. See, if misstatements, auditor identified misstatements, communicate for correction, management will correct something, management will not correct something. If at all they didn't correct, what is its impact on the opinion? Check out. If at all it is material and pervasive, you will give qualified opinion. If it is material and not pervasive, qualified. Material and pervasive, you will give adverse. Suppose if the mistakes total which are uncorrected or immaterial, you must get written representation. The auditor shall request written representation from management and those charged with governance. They believe the effect of uncorrected misstatements are material, and a summary of such items shall be included in written representation. What are all mistakes that you identified which are beyond triviality level but are not corrected? Getting it? List out. Get a declaration that they are immaterial. So in the declaration, what this entire list should be attached. Get a declaration. Tomorrow if somebody questions, sir, you mistakes identified, no, why you didn't give modified opinion and all, why you ignored just like that? Who said I ignored? I considered, I communicated, they said it is immaterial. I also convinced because of these reasons. And see, they gave a declaration also. Next, finally, the auditor shall document amount below which misstatements would be clearly trivial. Nothing but triviality level materiality amount you should document. Whatever misstatements that you accumulated during the audit, whether they have been corrected. So what mistakes you identified, how many were corrected, how many were uncorrected. What is your conclusion related to uncorrected misstatements are material on the, and what is the basis? So what is your conclusion about uncorrected? Are they material or are they immaterial? So on what basis you conclude they are material? On what basis you consider they are immaterial? Fourth one, written representations auditors obtained. All that you should document. That entire 450 is over. Entire 450 is over. So what is an uncorrected misstatement? Uncorrected misstatements are those that auditor has accumulated, nothing but identified during the audit but are not being corrected. And I already told you materiality standard, undetected misstatements. What is undetected misstatement? I already told you materiality standard. I hope you are clear on this 450. Look at the standard talks about, first the standard says whenever you identify mistakes, accumulate it. And so what is the consideration of identified mistakes? It may help, it may lead to revision of audit plan, audit strategy. Looking at the size of the mistake, nature of the mistake, all getting it. And request management to correct it. Some they correct it, some they may not correct it. Some if at all they are not correct, evaluate the uncorrected material misstatements on the audit opinion. If they are immaterial, get a written representation. Getting it. And finally, documentation. With this logic, 320, 530 understanding, then once again read 450, you will get clarity. So that's about 450. So that's, in our entire CA inter audit class, 450 is last but one standard we discussed. Last, we have totally 105 hours in CA inter regular. So in the 102nd or 103rd hour, we discuss 450 because 450 is something that you can't understand. In ICS study material, it is part of some 6th chapter, completion and review, which you are not supposed to learn at that moment. It's dangerous. Some 4th chapter, I think so. Getting it? You should not learn 450 at the beginning because you don't understand. Even in this particular class, I just gave you a brief idea only because it's a revision. In actual class, I will be taking 1 hour approximately. So in depth the standard is. It is connected with 300, connected with 530, connected with 330, 320. Only if you understand those three super perfect, then only you can understand this. Overall audit subject, if you understand, only you can understand. That's why in the marathon also, this is the last but one part. That's it. Okay, so 450 is completed.